flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills this Friday morning. Let's get to the three things that you need to know today.
First up, S&P 500 futures trading higher this morning as investors digest the latest economic data and earnings on the final trading day of February. Nvidia shares still under pressure today after closing down 8% following that mixed earnings print. That marks the worst post-earnings performance for the stock since 2018.
Plus, investors also assessing the latest read on PCE, the Fed's preferred inflation gauge, core PCE, which came in line with estimates showing inflation rose at a modest pace in January. However, personal income and spending surprising the street, with income gains topping estimates while consumers pulled back on spending.
And the Bitcoin sell-off continuing, with the digital asset plunging below that key 80,000 level, falling 25% from its record high. The downward price action comes as crypto investors gather for Bitcoin Investor Week as risk-off sentiment hits the industry.
U.S. stock futures rising after the latest econ data, and we got that fresh out this morning. The personal consumption expenditures, and ultimately this is the Fed's preferred inflation gauge. You're seeing futures actually moving higher by about 0.4% for the Dow, S&P 500. That's up by about 0.2% right now. And then additionally taking a look at the Nasdaq, that's trying to find its way. But it is, as the famous song would say, on my way here this morning, often not to the races, but flat, just trying to figure out what direction it wants to open up here 30 minutes ahead of today's opening bell.
Yeah, you've still got those big tech names, I think, weighing on the broader averages here, but that PCE print, let's zero in on that, because month over month and year over year core coming in line with expectations. But the big surprise that we wanted to focus in on, you got income up, but spending down. And consumer spending has been part of what's made this economy so resilient. So if that is a trend that continues, that could be a concern for the Fed and, of course, for our broader economy. Is this a sign of an economic slowdown? You can see on your screen personal income up by 0.9%. That was mainly driven by things like farming, trading income, and even Social Security. So don't expect that to mean you're getting a raise anytime soon. But on this flip side here, you've got personal spending down by 0.2%. The estimate was for a gain of 0.2%. So that could be a sign here that we are seeing a little bit of a potential slowdown, and that could potentially lead to a little bit of concern for the markets, though it does appear that we are on track to recover.
Yeah, looking at some of the categories here as well here, because the $30.7 billion decrease in current dollar PCE in January, that actually reflected a decrease of $76.7 billion in spending for goods and an increase actually of $46 billion in spending for services. So that continues to spell out the strength in services spending that we're seeing in that pullback in goods spending. And which goods? Well, category by category right now, looking at motor vehicle and parts, that was the biggest decline that we saw during this most recent reading here. That was down by about $41.1 billion, it looks like here. And so all of these things considered, on the services side, it really is still housing, shelter costs, and utilities that are holding up the services spending on that side. That was up by $29 billion.
Yeah, and housing is such a critical indicator of how consumers feel about the economy. When housing's expensive, you don't feel great about the economic conditions. But let's recap. The Fed's preferred inflation gauge slowing as expected in January. Core PCE rising 0.3% from December and 2.6% on an annual basis. That is the smallest year-over-year change since 2021. Joining us now to discuss, Steve Rasciuto, Mizuho America's chief U.S. economist. Steve, great to speak with you here. Just want to get your reaction to the PCE print. Does this change your outlook for the economy? Do you see any more signals of slowness to come to the economy?
No, I really don't. And I think the key driving point here is that consumer spending was up over 4% in the fourth quarter of the year. So, and a lot of that was driven by goods. So to the extent that there is some correction that takes place in that to a more normal level of spending, it's really not a surprise. We saw a huge surge in auto sales in the latter months of 2024, and now we've seen a bit of a correction back in that in 2025. The underlying trend rate from services continues to be very, very solid, and that will dominate. There's also been this historical pattern since 2008, where basically you have a very robust fourth quarter and then a weaker first quarter. And when you average the two, you're still running above trend. And it looks like that pattern is going to continue in here. And the kind of income gains that you're seeing here, 0.9%, is critical. And when you say, well, that's Social Security, you have to understand, not only was there a bump up in Social Security that took place from a cost of living standpoint for a lot of America's retirees, there was also the transition that took place in terms of the Social Security Fairness Act, which increased Social Security contribution payments made out to government workers who receive government pensions. And I can assure you they're going to go out and spend that extra money, and I'm sure it'll be reflected in the February and March data as we go forward.
Steve, I guess what do you make of the consumer right now, considering the services weighting in spending that we're continuing to see? As of right now, it's looking like it's all areas and categories within that services that are needs, not necessarily wants. So that also spells out a consumer potentially that is saying to themselves, all right, in other kind of parts of the home, we're penny pinching, but in those needs, like we can't help it but to continue to spend into those services because they're critical.
Well, again, I disagree with the interpretation that they're penny pinching. I mean, I think the environment of a very robust fourth quarter on goods spending and then some correction in January, you went out and had a great Christmas season. So after that Christmas season, do you then have to go out and satisfy additional consumer-related spending on goods? Services drive the economy, and people are willing to pay higher rents and comfortable paying higher rents when they're receiving more in their employment and they're receiving more in the government subsidies that come to them. And it drives the economy forward. Are we going to see an economy in Q1 that is exceptionally robust? No, but are we going to see an economy when you average Q4 and Q1 is running above trend? The answer is yes. And I think we'll continue to run above trend throughout the entire year. You have to realize that the Biden administration on its way out the door spent upwards of $500 billion. The Federal Reserve cut interest rates 100 basis points in the end of last year. So we're just getting into the point where those interest rate cuts and that fiscal stimulus really begins to drive the economy in the first half of 2025. And I think we're going to see it as we go forward in through the quarter and pick up into the second quarter of the year. This is nothing more than a temporary dip in the data after an exceptionally robust Q4.
And Steve, perhaps we're painting a brush a little bit too broad here, because there certainly are some areas, cohorts of the consumer that are penny pinching right now, that have felt like they've been in a recession for the better part of 18 months, especially on the lower income side. And I believe you and I have spoken about that before. I guess the larger question on aggregate is, at what point would you be tracking some of these services growth that we're seeing, and whether that be on a percentage basis, on a dollar basis, whatever the case is, how that is keeping pace with, or wages, I should say, keeping pace with some of that service spending as well?
Yeah, well, when you've got a 4.1% unemployment rate and you're below the natural rate of unemployment, which is the frictional level of unemployment, you're going to have continued gains in wages. So that's critical. The other thing to keep in mind is the data over the past few months in terms of the lower income cohorts of consumers are starting to show that all the delinquency measures which were rising heading into the second half of 2024 have started to roll over and are starting to improve. Yes, some of these people, some of the lower income households have certainly pulled back. That's a healthy thing. And it set the stage for better financial conditions for them going forward. And then you put on top of it the fact that we have a continued tight labor market, a Federal Reserve that wants to continue to keep the labor market tight, and a fiscal policy that spent a heck of a lot of money. You're painting a picture that says sustained upside economic growth, or I should say sustained above trend economic growth, is the more likely scenario than a dip below trend GDP, and definitely a long way from anything weaker than that.
So you're not concerned about stagflation?
No, I'm not concerned about stagflation. I think you could make an argument at some point in time we might have stagnation, but stagflation requires that you have a global demand, excess demand for tradable goods. We don't have that. We have a global excess supply of tradable goods. The underlying service inflation is probably enough, given what we expect to happen in some of the other categories on goods with regard to the currency, are enough to keep us around the 3% inflation rate. And when you look at these PCE numbers, yeah, they're in 2.6% year over year. That's down from 2.8. 1 month does not make a trend. 2.8, 2.6 are a heck of a lot closer to 3 than they are to 2, which is the Fed's target.
And I know you don't see a chance of rate cuts this year, but we're increasingly hearing calls from other folks on the street, including Torsten Slok this morning, indicating that there is an increased risk of a recession. What would change your call on no cuts for this year?
Well, I think the concept is an increased risk of recession relates to the equity market, and the equity market has dipped in here. But you have to understand something. The equity market has been exceptionally robust relative to earnings. And what you're really seeing is a correction in the technology stocks. When you look at the equally weighted index, it's going nowhere. And you look, it's basically flat. So all the concentration is coming down on the Mag 7. Yeah, a lot of the bulls would have liked to see the correction take place where everything else catches up to the Mag 7. But the correction we're seeing in here is actually one where the Mag 7 is coming back to reality, and the earnings numbers are beginning to drive the equity market again, which, to be honest with you, a year ago when the Mag 7 were going through the roof, everyone kept on saying, well, this is a problem. We've got an equity market that's horribly imbalanced. Something has to go wrong. Something has to break. Now that we're correcting, it's like, oh my God, it's correcting. Something has to break. Everybody always has a something have to break argument, and they're easy to make, but the problem is they have proven to be wrong every time since 2002, and we're now on our 7th recession call. And I hate to say it, it's going to be disappointed again, as the previous 6 have been.
Stephen, thanks so much for taking the time here with the reaction to today's PCE report.
Cheers.
Bitcoin continuing to fall down 25% from its all-time high in January as investors flock to safety. President Trump vows to impose tariffs on Canada and Mexico, as well as additional tariffs on China. Let's go now to Yahoo Finance executive editor Brian Sozzi live at Bitcoin's investor conference with Anthony Pompliano, professional capital management founder and CEO. Soz, take it away.
All right, thanks so much, Brad. Anthony, good to see you, host of the Bitcoin Investor Week Conference. Thanks for having us. Brad was talking about this sell-off we've seen in Bitcoin. To the average human being out there watching this slide, I think it's down 27% over the past 6 weeks. What are they seeing?
Well, I don't think that people should really be that worried, right? If you go back and you look at the 2017 bull market or the 2021 bull market, historically we see anywhere between 4 to 7 drawdowns of 30% or more. And so really what we're seeing is just what has always happened. Bitcoin is a volatile asset. That's what people are buying. It's buying volatility. So if you want Bitcoin to go up, you've got to be okay with it going down sometimes. And these kind of cooling off periods or these consolidations are very natural.
This room is packed. I mean, this is a buzzing room. Who's in this room? Is it more retail investors or the institutional folks that I would argue have been driving Bitcoin to new highs before the sell-off?
Yeah, there's about 1,000 people that'll be here today, and really it's a combination, right? We've got a lot of institutional folks, both as speakers, but also every single institution on Wall Street is interested in Bitcoin now. They want to understand what is it, how does it work, what should we be doing with it, and what can it do for our organization. Also, we've got a lot of self-directed investors, and those people really have been buying Bitcoin. They kind of beat the institutions to Bitcoin, and so they want to understand, where are we going from here, and should they be changing anything in their portfolio?
Getting back to that Bitcoin sell-off, Binance's CEO, Richard Tang, has been on fire on X. He thinks this is a tactical retreat in prices. Would you agree with that?
Yeah, look, I really don't think that anyone should be worried whatsoever. Like, if we go back, on November 1st, Bitcoin was $69,000, right? So we're up since the election. But you wouldn't know that if you go and you look at the sentiment online. Everyone loves to kind of freak out. But if you also go and you take a look at other assets, gold is down, stocks are down, right? This is a global liquidity conversation. It's not a Bitcoin-specific thing. Bitcoin just happens to be the asset that is most sensitive to global liquidity. And whenever you get that sensitivity, if liquidity is contracting, Bitcoin will go down. When it's expanding, you're going to see Bitcoin rip to the upside.
What I think it surprised me, Anthony, is I've always come to think Bitcoin is the place where people go when things get a little shaky in the economy. For whatever reason, that's what has happened in the past. We've seen more tariff talk now hitting markets, and we're seeing Bitcoin sell off. Have these assets become correlated? Bad tariff headline, Bitcoin prices have to retreat?
Well, I think that actually Bitcoin is up since Trump got elected, right? So when you think of it from that perspective, people have gone to Bitcoin. He got elected, Bitcoin was a huge winner. $69,000, ran all the way up to $110,000. And so I think what people are really showing is that they understand his economic policies, they voted him into office, and Bitcoin was a big winner from that. Now this is kind of a consolidation or cooling off, and so what I think we've got to do is we won't be able to answer this question until we get towards the summertime. And so if Bitcoin then turns around and rips right back to all-time highs, we'll say, hey, you know what, that was a consolidation, not a big deal. If Bitcoin stays sub 100K, then I think people will start asking, very different questions.
Earlier this week, I caught up with Robinhood's co-founder and CEO, Vlad Tenev. He said, it didn't sound like we're getting a Bitcoin reserve this year, but we may get a stable coin regulation. Do you think we get a Bitcoin reserve?
I think we'll get both. Stablecoin regulation is going to be very important. I think we will get that. But I also think that there's very different forms of a strategic Bitcoin reserve. We can hold the 200,000 Bitcoin that we have and just say, hey, we're not going to sell it. Technically, that'll count. And I don't think that's what people want. I think people want the United States to go and buy Bitcoin. And the question is, what is that process? Can it be done through executive order, or are we going to have to go through kind of the legislative process, which will be much harder and may not happen this year?
Bitcoin reserve, where does Bitcoin go?
Much higher, much higher. Yeah, I mean, look, anytime that you look at kind of these new pools of capital entering into the market, usually there is some initial, buyer that provides career cover for everybody else. So you saw Paul Tudor Jones and Stanley Druckenmiller do this in 2020. They came out and said, we own Bitcoin. Every portfolio manager on Wall Street could then go buy Bitcoin. When you saw BlackRock and Fidelity come out and say, we're going to have an ETF, every single financial institution, they're in the game. If the United States of America starts buying Bitcoin, every country in the world now has the cover to go and do it the same. And so it's not just a U.S. story, it's going to be a global FOMO story, and I think that pushes the price much, much higher.
Should meme coins be securities?
Well, the SEC, who's much smarter than me on these topics, they say no. What I think is probably an interesting second or third order effect is if you now have a digital collectible that's not going to be a security and they look like these meme coins, I think you're going to see a lot of other asset issuers say, how do I take my asset, put it into a digital form, and have it fall under this digital collectible kind of rulemaking? What the effects of that are, I don't think we quite understand yet, but anytime that you can show some of the incentive, you can pretty much understand what the outcome's going to be. And so now you're going to have these digital issuers saying, oh, I'm just a meme coin, I'm just a collectible, please don't regulate me. On one hand, it'll be lower costs for them to operate, which I think is what they'll be going after, but also I think that there's a reason why securities laws exist, and we want to be very careful about that.
All right, let's get, after this conference, I think you got to go sign some autographs or something. Anthony Pompliano, good to see you. Talk to you soon.
Thank you so much.
All right, Brad, back to you.
All right, Anthony and Brian, thank you both so much for joining us. Coming up on Morning Brief, we're going to count you down to the opening bell on Wall Street. Plus, we'll check in on shares of Nvidia, that's selling persisting after earnings, though the shares popping around a bit this morning. Also, Meta going all in on AI. What does that mean for the company's stock performance? We're going to discuss that and much more on Morning Brief.
Now time for some of today's trending tickers that we're tracking. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we're tracking shares of NVDA, the market cap falling below $3 trillion after the chip maker's fourth quarter results failed to wow investors. Yesterday's steep drop wiped out about $273 billion in value. Nvidia first hit a $3 trillion market cap in June of 2024. Taking a look at shares here this morning, adding on to some of the declines that we saw on yesterday's trading activity here and lower pre-market by about 2%. Now, for anyone who was tracking some of the options contracts coming into this earnings report, yesterday's move lower should come as no surprise. We were talking about it even going into, and I had mentioned an 8.5% drop was what those options contracts were pricing in. That's exactly what we saw yesterday. In terms of what we could potentially see investors try to focus their attention on from here, I saw Yahoo Finance's Pras Subramanian had a story up about the auto business and how that essentially doubled. So one of the bright spots, at least last quarter. But then moving forward, it's also going to be about the margins here and ultimately seeing how Nvidia can extract even more margin from its customers. And some of those customers are trying to figure out how we're going to be able to cut some of the costs around the generative AI and inferential computing that's going to be coming forward.
Right, that's what we heard from the likes of Dell, which I know we're going to talk about in a second here. But I thought it was fascinating to see the price action on Nvidia after those earnings, because we saw the stock whipping around a little bit, right? There was a moment where it was up about 2% around the market open on Thursday, and then around 10 a.m., you get some headlines from the Trump administration about export controls and tariffs, and then you start to see this sell-off coming up here. So is the policy driving the price action on Nvidia? That, of course, remains to be seen. What we do know is that this was the worst post-earnings day for Nvidia since 2018. That was before the AI of it all. That was when gaming was the primary business for the company. So this is a very significant sell-off. And if you take a look at Wall Street Bets Reddit this morning, you got a lot of traders who are really feeling the pain today.
Back in the days of the GPU business, taking up all of the air.
Yeah, exactly. They're wishing for those days again. And you know, Nvidia typically has a comeback story after those earnings, and we'll of course continue to cover all of those moves. But let's move on here. HP's profit outlook for the current quarter falling short of expectations as the computer company expects to take a hit from tariffs on goods from China. Yahoo Finance executive editor Brian Sozzi spoke to HP's CEO about the potential impact on prices. Take a listen.
What we have shared is our recipe to respond is first, to rebalance our install base, second, to look at additional cost, and eventually, if we have to, we may look at prices, but we put that the third in the list because we want to protect our customers, we want to protect our consumers.
HP also planning to lay off up to 2,000 more employees this fiscal year, and you can see here the stock down over 4% right now. Their adjusted EPS coming in short of estimates here and coming in at 75 cents versus the 85 cents that were expected. Just to run through a little bit of the analyst commentary here, Morgan Stanley noted that the company's guidance moving forward feels a bit too ambitious given many market uncertainties, and I think that is a covert mention of the Trump administration policies. And we continue to hear this kind of back and forth from the market on whether or not Trump's policies are actually going to weigh on stocks. But when it comes to individual names, a company like HP, it does seem like not only the tariffs on China, but also export controls could be a headwind for them moving forward.
Yeah, one of the other notes out this morning, that was from UBS. They essentially moved their, and they have a rating right now of neutral, $37 price target. David Vogt, he was actually out with two different calls here this morning, both HP and HBQ, so separate HP entity. But then additionally on Dell, which is another kind of in tandem happening around HPE, looking past this larger reset taking place here as we're taking a look at shares down by about 5.7%. Their target there on a buy rating is $150. That is actually lower though from the $158 that they had previously, and said they are looking past the fiscal year 2026 reset there and expect non-AI end markets to recover in fiscal year 2026. So there you're seeing that move on shares of Dell here this morning too. Finally, we got to talk about Meta. Meta reportedly planning to launch an AI app in the second quarter of this year as it looks to compete with OpenAI and Alphabet. Meta also plans to test a paid subscription for its AI services. You're taking a look at shares of Meta up fractionally pre-market. Now, what was also rattling around social media last night was this posted video of a clearly AI version of Mark Zuckerberg as Sam Altman is kind of putting the warning shot out there for some of the existing social media companies, saying he's ready to also launch a social media app too.
I mean, what matters is who's going to get the most money for it, right? And what I think is interesting about this announcement from Meta is that they are going to plan on charging people, having a paid subscription with additional AI features. The pricing is unknown. And according to some reporting over at Reuters, a source in Meta said that that subscription service will begin in the second quarter of this year, but the company does not expect subscription service revenue until next year at the earliest. So come this time 2026, Brad, which of these companies is going to have the best balance sheet when it comes to ROI on AI spend? That's the key question, in my view.
Right, whichever one makes the best free experience first.
Right.
That's what it's going to come back to. I mean, let's think back. When we were beginning the search and the ranking that Google rolled out en masse and was able to make free for everyone who could have access to an internet, you weren't saying, oh, how much are you paying for your Google experience?
Yeah.
Nobody was talking about that. You're saying there's this free service online. All you got to do is go to google.com and essentially type in whatever you want to search, and it'll spit back to you in fractions of a second, microseconds, what exactly you were potentially looking for, whether it was based on an encyclopedia reference. All of those things considered, that same mind share or mental capacity for how people are thinking about the next wave of technology with regard to any type of generative AI is going to have to come with a free option.
Yeah.
There are still people who want free streaming services.
Right, that's true.
And we needed to see good free streaming services until they were then eventually monetized. So when we're looking at the growth cycle for a lot of these companies who are trying to say, oh yeah, we're going to roll out a monetized app or a monetized option, it's going to come back to how well they get free correct out of the gate. And then from there, how they're able to make sure that the monetized experience also adds on incremental value.
Right.
Otherwise, nobody's going to want to buy into that and pay for it.
Right, I just started using ChatGPT 2 years ago.
And are you paying?
And now I have to pay for it already. You made a great point about, the timeline from when we were getting really affordable streaming services to when they started to raise prices was a little longer than the timeline we're working with at the moment. So it's going to be interesting to monitor those price hikes for sure moving forward. But we are minutes away from the opening bell on Wall Street. We're going to be right back with more coverage after this.
We're taking a live look at the opening bell at the New York Stock Exchange and at the Nasdaq in Midtown Manhattan. Yeah, go ahead, press that button, get some funfetti. And at the New York Stock Exchange, you've got the U.S. Customs and Border Protection Department ringing the opening bell there. All right. As we begin today's trading activity, let's take a look at the major averages just after the opening cross. We're taking a look at the Dow right now. That begins the day higher by about 0.2%. Of course, big PCE energy out of the gates here this morning. We're continuing to track, though, the S&P 500 trying to find its way as that's in a kind of hyper waffle phase out of the gates at the opening cross. And the Nasdaq Composite, I believe that's calibrating for us here. But ultimately, as we're continuing to kind of pair that up against this week, let's populate this line graph for you here. We heard you like line graphs, so we got a couple of those for you. We'll take a look at the past 5 trading sessions. We are still net lower by about 5% over that period, and I believe this has calibrated. We've calibrated lower. We're down by about 0.3% to start off today's trading activity for the Nasdaq Composite here. And then additionally, taking a look at some of the sector activity out of the gate this morning. I want to load up some heat maps here where we've got staples leading the pack as of right now. XLP, that's up by about 1.2%. You down with XLP? Yeah, you know me. All right, well, anyway, XLE, that's pulling up the caboose. Right now, that's lower by about 0.5% here on the day. And then lastly, let's ride out with a quick look at the Nasdaq 100. You've got quite a bit of red, but hey, you've also got a lot of gainers here. Let's put this on an equal view just so you could see how that split. Yeah, we definitely got way more gainers than decliners here, but bringing up the caboose, and this one's noteworthy. We're going to talk about this one in a hot second. Palantir, that's lower by about 6% to start off today's trading activity here. That is a deep, kind of slash shallow tease for what we're going to dive deeper into in just a few moments here. But you've got Monster leading the pack here. You've also got GFS. We don't see that leading the pack very often, but that's starting off the day higher for Global Foundries by about 2.2%. All right, you can take some time, dig into that further, or you could stick around and listen to Jared Blickery because he's going to take a deeper dive into what's moving out of the gate this morning. Hey, Jared.
Hey, Brad, we got some monthly, mostly losers here. I wanted to say winners, but let me just go through some of the stats, and I have a lot of stats. First, I'm going to dial up a 19-day chart because that is how many trading days hath February, I guess, as the old rhyme goes. So you can see the Dow is down 2.65%. That's not too bad, but then we get to the S&P 500 having its worst month since April of last year. That's down 3%. And the Nasdaq and the Nasdaq 100, both of those in the same camp. Nasdaq Composite down 6% and the Nasdaq 100 down 4.76%. Both of those having their worst month since September of 2023. So we're going to get some dates that stretch pretty far back in time here. I can also go to the 10-year T-note yield. That has had that was coming in the right way with supporting risk markets. That is down to 4.25% right now. It has had its biggest drop since December of 2023, and the U.S. dollar, which tends to move in the same direction over the long term as yields, at least recently, that is down about 70 basis points, which really isn't a lot, but that was the most to have it fall the most since August. It has been on the rise recently. And then we can go to our sector action. And I've been tracking the relationship between staples and discretionary. So consumer staples, the stuff you need, discretionary, the stuff you want, and they have been at opposite ends of the spectrum. Here again is that month-to-date look, and you can see XLPs. That is in the lead, followed by real estate and energy, and then really far and away, just plunging to the downside, XLY down almost 9% there. Tech also an underperformer, that is down 5%. And we can really see this playing out in the Nasdaq 100. I'm going to leave on this month-to-date time frame, just a few hours into the close here. But for the entire Mag 7 index, this is the worst month since April of 2022. And in fact, this bull market began somewhere around October of that year. So this goes back into that bear market. And I think that's pretty significant. So not only the Mag 7, but Tesla and Amazon also having that worst month since April of 2022. And I'll just show you a couple charts here. Alphabet also not doing well. Let's go to the month to date for that. And we can see it is down 18%. So some pretty significant movements here for the big guys, the generals. You can see Tesla here that I'm circling. That's down 32%. And even Meta. Remember, Meta had that 20-day winning streak earlier in the month. That is having its worst month since July of 2024, and I'll show that real quick, down about 6.64%. I'm going to close here on Bitcoin because that is really stealing the show as far as headlines. That is down 16.6%. Let me do a trailing 1 month here, down 20%. And that is the worst month and week since 2022. Here is the 19-day. Let me just show you a year to date so you can see down 13.9%. I've shown this chart quite a bit. We broke that topping formation that we have, and it looks like we're heading right back down, maybe to 70. I don't see a lot of support at 80, 81. But on that note, I'll send it back to you guys.
All right, Jared, thanks so much for tracking those moves for us this morning. It's time now for today's strategy session. The bond market seen its biggest rally since July, with the 10-year dropping to around 4.2%. But as investors digest the latest read on the economy, are these gains sustainable? Joining us now to discuss, Janet Rilling, Allspring Global Investments Senior Portfolio Manager. Janet, great to have you on. As you know, the 10-year yield on track for its 7th week of declines. What is the price action telling us about the health of the economy?
Morning. Yeah, I think that the bond market has been watching the fiscal headlines pretty closely and trying to understand what the second order impact is. And given there's a large degree of uncertainty, I think that is weighing on the view on economic growth. We are still constructive on growth for this year and think it will be positive. But given the uncertainty, we know that corporate leaders are starting to slow play some of their strategic decisions, maybe merger and acquisition activity, maybe CapEx investment. And that does lead to a lower view in terms of growth outlook.
And so what do you think a better estimation or better kind of outlook for that growth is potentially kind of more tempered at this point?
Yeah, I think still achieving 2 to 2.5% growth is possible, but that is a deceleration from what we saw in 2024.
To what extent do you think that policy from the White House is driving some of that movement? I've heard sources arguing on both sides of things that the policy is just noise. The slowdown was already in the market prior to that. That's what Neil Dutta has to say. Whereas others say that the tariffs and the sequence of policy, with tariffs coming first prior to tax cuts, is going to weigh on growth. What do you think?
Well, the direct impacts from policy are not yet in the numbers. We are still waiting for some of it to be implemented. It then takes time to work its way through the economy. So I think the effects we're seeing now are more on sentiment, the anticipation of what the tariffs mean, and then also from the consumer standpoint, maybe a bit more uncertainty. I mean, the job picture is strong for the consumer, and a consumer tends to spend when they have a job. But there is an increased level of uncertainty. I mean, if you think about DOGE and some of the cuts in government, while many of the government workers will retain their jobs, it has increased uncertainty for them, and they may cut back a bit on spending. So I think just this level of uncertainty is impacting not only corporate decision makers, but consumers in their decision making. As we get a little more clarity on policy, that may take that element off the table. However, we will then start seeing the effects of the actual implementation. And I will say, it's not clear that these policies will have a negative impact. They are complex. They some may add to economic growth, others may detract. And so it's a really uncertain environment when you try to net all these items out. And in our view, just a little too early to have good clarity to predict.
It seems like the consensus is that the policy will still have and some larger kind of implication for volatility. And with that volatility, we've heard calls, even from UBS this morning, saying it's time to be bullish, acknowledging that the volatility is going to stem from that policy and the will they or won't they of tariffs, and then what will that do to the economy, and then what will the Fed do? What, from your best gauge, is the best kind of animal spirit for investors to employ right now?
Well, first of all, from a fixed income standpoint, we do think now is a good time to allocate some of your portfolio to fixed income. And that's because the overall level of yields is higher than it's been for quite some time. In terms of the volatility, we do think it's going to be elevated because the range of outcomes is wider than it's been for some time. But that said, you can take a longer term view, set your allocation, and then shift your portfolio in an active manner to the sectors where there's a bit better valuation. So for us, we're emphasizing, for example, structured product in our portfolio. Here, we think the valuations are a bit better in the current environment. But it's this idea that you do want to have the longer term allocation to get that ballast in your portfolio. Duration serves at times as a cushion to equity market volatility. And we think having that foundational allocation in an investor portfolio is important.
Janet, thanks so much for taking the time here with us just after the opening bell. Appreciate the insight.
Thank you.
It's time now for our chart of the day. And today we are taking a look at shares of Palantir. This chart here showing the number of retail traders buying into the stock at a time where company insiders are selling. Notably, CEO Alex Karp this week selling $44.6 million worth of shares. Now, of course, executives do have to disclose what their share selling plans are. His is one of the more recent, especially for a name as large as Palantir that has played out within the retail landscape over the course of, I would say, the better part of the last year here. There seems like there's been a lot of social chatter on Palantir, and as we're measuring by some of the inflows here, that certainly has kind of mirrored what we've seen on this spending propensity, or at least those who have looked at shares of Palantir and identified what their entry point is.
Yeah, it's a significant story when it comes to Palantir because of just the run-up that we've seen and then this fall to the downside. I'm hearkening back to my Bloomberg days when one of my co-anchors would put me through a weekly quiz on what the best and worst performers were for the S&P 500 on the week. And taking a look at this week, Palantir is one of the worst performers, just a couple of stocks performing worse than them, including the likes of Vistra and Super Microcomputer. So that's significant when you think about the run-up that Palantir has had, and now they're coming off of those highs. The question is whether or not that's just a little bit of profit taking or whether it's something more sinister. And the reason we wanted to show this chart on retail interest in the stock is because there is this idea that when retail investors coming in, that is the quote-unquote dumb money. We would never call our retail investors dumb, but this is just an idea on Wall Street. When the retail dumb money comes in, smart money leaves. And you are seeing that insider share selling at the same time. So is that an indication of bearishness to come for Palantir? That is the question that a chart like this raises here.
We are going to reframe the term dumb money
Yes.
within the next, we're gonna do it. We're gonna workshop it here.
We'll come up with something in the break.
Just because you don't have as much as some of the institutions and some of the insider traders.
Yes.
Yeah.
I agree with that.
We can be their marketing team.
Yes, yes. We will rebrand the movie Dumb Money as well. We'll come up with a better title for that. All right, coming up, we're talking to the CEO of Duolingo after the company's latest earnings results. Stick around for that conversation next. Shares of Duolingo taking a jump to the downside here, down about 16% this morning. Now that comes despite the company's fourth quarter revenue beat, driven by 51% increase in daily active users and a 43% jump in paid users year over year. Joining us now with more on what's next for the company, Louis Van Ahn, Duolingo's CEO. Louis, thank you so much for joining us this morning. There was a lot of good news in the print. You had a beat on the top and bottom lines and strong guidance, but the street is clearly disappointed. What do you want to tell investors?
Well, we're generally very excited about everything that's coming up. In particular, we have historically we've had the free version of Duolingo and also the premium version called Super Duolingo. Over the last, call it, year and a half, we've started adding a new higher tier called Duolingo Max, which is getting really good adoption. It's about twice the price of Super Duolingo, and what it has really good AI features that help people practice conversation, and we're seeing really good adoption on that. And so, we're very excited about that.
What are some of the expectations for growth that you have going out this year, and that would really point to some of the ultimate number of users that you have opting into that max feature as well?
Yeah, I mean, our growth, first of all, we're growing in every region. We really are, every single region has high growth rates. And one thing that's really interesting is that even regions that are pretty mature for us are still growing fast. So we think there's a lot of room for that. And then there's a lot of room for people to subscribe to Duolingo, Super Duolingo and Duolingo Max.
Well, one of the things that's interesting and that the street is disappointed with this morning is the margin pressure, which is caused in part due to your strategic decision to invest a lot upfront in AI and then hopefully reap the benefits of that later on. Given the stock price dip that we're seeing today, do you regret that strategic decision?
Look, we're in a unique point in time with artificial intelligence. We have decided that we're going to invest, particularly the first half of this year. We're going to invest quite a bit on making much better features that are related to AI to teach better. In general, I think this will open up a lot of things. For AI, there are two big parts where we invest in AI. There's one which is creating content that is actually cutting costs, and we really like that. But then there's the part that particularly has to do with conversational practice. There, we're not even trying to save costs right now. We're using the latest models because we want to develop as good of a feature as possible, and we know that over time we're going to be able to decrease those costs, not only because the models themselves are going to get cheaper, but we can also optimize. But at the moment, we're just trying to go as fast as possible with that.
Louis, I enjoyed my days growing up, taking French classes. Now, as an adult, I must admit that my French is, at best, masterfully bizarre and sporadic. At this juncture, though, there is so much AI and artificial intelligence out there that has removed the need for a lot of younger people and people who are just trying to get into learning a new language to feel like they need to learn it. So how are you kind of combating the threat of AI and analyzing how the business is going to ultimately go up against some of the other major tech companies who are just saying, hey, we can integrate this into an experience that we already have where we know we have an install and a user base?
Yeah, in terms of learning a language, we're not particularly worried about that. We have, our users fall into two big buckets. One is hobbyists, people who are just learning a language as a hobby. Whether, AI can have immediate translation or something like that doesn't matter for people who are learning as a hobby. A good example is with chess. Computers are better at playing chess and have been for the last 20 years, but people still learn chess. And then the other big bucket of users that we have are people learning English. And people who are learning English want to learn English, and they're going to want to learn English regardless of whether a computer can do immediate translation or not. So that is not something we're particularly worried about.
It's interesting in the context, though, of what you were talking about previously, which is this focus on investing in AI upfront in order to have gains later on. I know that you don't currently plan on charging additional fees for your AI offerings. At what point do you sit down with your CFO and say, okay, we got to get these margins up. We got to start charging more for these AI offerings like those video calls that you have on platform?
I mean, in general, our margins, we have over the last couple of years, our margins have expanded massively. I mean, we really were basically break even, and by now we're at like 25% adjusted EBITDA margin. So we've done pretty massive margin expansion over the last 2 years. We're still going to expand margins this year, but it's just going to be a little slower than previous years. And mainly it's because of this investment in AI. I think it's the right thing to do at the moment.
I want to just enjoy a question with you at the end here, Louis. Me, like so many people on the internet, are obsessed with Duolingo's social media presence. And just as a CEO, I'm just curious, like, are you meeting with your social media leads weekly? What does that look like? Operationalize that for me and talk to me about how you have strategically thought about rewarding your social media team given their success.
Yeah, look, we have our owl mascot decided to fake his own death because he really wanted to get the attention of Dua Lipa, and he also wanted to get people to do their lesson. I didn't know he was going to do that. This is what happens when you hire creatives like the owl. They have a mind of their own. We've talked to him. He's not going to fake his own death anymore, and we've also convinced him not to do illegal things going forward. But we have a loose cannon there with the owl.
Wow. A fictional owl doing illegal things. Louis, we have really kind of going into a deep humanization of our mascots out here. Thanks so much for taking the time here with us. We'll continue to track the stock price reaction and the brand story going forward. Louis von Ahn, who is the Duolingo CEO. Thanks so much.
Thank you.
We've got all your markets action ahead. Stay tuned. You're watching Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. So let's go. First up, Autodesk beating on the top and bottom line in the fourth quarter and providing strong guidance. For 2026, the software firm sees adjusted earnings per share, that EPS, of $9.34 to $9.67. That is well above the estimates for $9.23. The lower end of the revenue guide meeting estimates as well. The company also announcing plans to cut 1,350 jobs in order to focus on profitability. RBC Capital calls the 2026 guidance bullish. KeyBank touting the firm's operating margin, free cash flow outlooks, as well as the restructuring plans.
Plus, Rocket Lab plummeting after delaying the launch of its Neutron rocket to the second half of the year, falling short on revenue expectations for Q1, seeing $117 to $123 million versus estimates for $136 million. Wall Street is mixed. TD Cowen putting its price target under review, KeyBank lowering the target, but analysts also argue it may not matter so much to the long-term story. Citi saying they haven't come across a space program that has not been delayed.
Yeah, true. Finally, Monster Beverage rising after topping gross margin expectations in the fourth quarter. Revenue essentially in line with estimates while adjusted earnings per share missed. JP Morgan highlighting the constructive tone of the conference call, seeing optimism for recovery in the U.S. while acknowledging January performance was impacted by weather events and the California fires. Morgan Stanley is expecting rebounding category growth and positive impact from price increases, while Truist remains skeptical of long-term growth in a mature market with increasing competition. All right, that does it for Morning Brief. That's it for the 9 a.m. hour, but you can join Maddie in the next hour for more analysis on Catalyst and myself at 11 a.m. for Wealth. You're watching Yahoo Finance.
Welcome to Catalyst. I'm Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the 3 catalysts we're watching this hour. First up, we break down the outlook for interest rates and what that could mean for your portfolio. Plus, recession risks on the rise on Wall Street. What are the signs to watch for? And what does it mean for the market? And investors digest looming tariffs coming as soon as next week. We'll look at what that means for consumer sentiment and businesses. Half an hour into the U.S. trading day, let's get a check on the markets here. You've got your tech-heavy names still weighing on the Nasdaq, down about 0.2%, a tenth of a percent, waffling around a bit. You got your S&P 500 up nearly 0.2% here. You've got your Dow holding on to gains as well. All week we've been seeing the Dow and the Nasdaq trading places. If one is up, the other is down. Again, those tech-heavy names being really dragged down by the likes of Nvidia. You've got some of your other Mag 7 names, though, like Meta, still leading the pack when it comes to the upside. But let's flip the board over to the bond market because you've got the 10-year in particular. The yield on the 10-year on track for its 7th week of declines here. Yields continuing to be under pressure. The question is whether or not the Treasury market is pricing in a growth scare moving forward, or if this is a sign of continued economic expansion that the president and his team are trying to usher in. We're going to ask that question to some of our guests in the show today. But finally, I want to take a look at gold because gold is on track for its worst week of the year. You can see the pressure gold is under, but it's not the only commodity under pressure. Though in the digital asset space, we've got Bitcoin down today, nearing that 80,000 key level. If it dips below that level, a big question as to how low it could go moving forward. Though I should mention it is still up about 18% since the election of Donald Trump. Well, U.S. stocks are set to wipe out year-to-date gains as investors grapple with hotter than expected inflation, looming tariff threats, and an uncertain rate environment. So how can investors best position? Joining me now with more, we've got Steve Sosnick, Chief Strategist at Interactive Brokers. Steve, great to have you. There's obviously so much uncertainty in this market right now. Where are you finding the most conviction?
Well, I still see a lot of conviction among individual investors who have been very successful over the past few years at buying dips and following momentum trends. They're still believers in this rally. I think on the flip side, though, you are starting to see a bit more nervousness creep in, certainly from institutional investors, and some individual investors have started to waver in their resolve about buying stocks lately. The sentiment has definitely soured among consumers, and it's sort of almost, you could bifurcate the market now into investors sort of view, they have this wealth effect from all the money that good investors have made over the last couple of years. It's been phenomenal 2 years, certainly. But then there's all the other consumers who are not investors, and ultimately those consumers who are feeling stretched start to weigh on the market and the economy as a whole.
And to what extent do you think we are heading towards an economic slowdown that one could describe as a recession? And if you do think we're heading towards that, then what trade might that initiate?
Well, I do think that I'm not going to play economist here. That's a little out of my bailiwick. But what I will remind everybody is GDP, which is a recession is basically the short version is two successive quarters of negative GDP, which we have not seen yet. But remember, GDP is consumer plus investment plus government plus net exports. Well, we've had a period where fiscal spending was huge. It led to inflation, it led to some other things, but it also really helped GDP. Well, now you take the G in the equation, throw it into reverse. That also has multiplier effects, and it's starting to spook the consumer, which is the C. So both of those can really start to weigh on the GDP even more than the net exports, if they are helped by tariffs, which can be an open question. Is enough to bail that out, and I don't know that it is. And the fear here among a lot of investors now has become that the economy could be slowing down faster than the Fed is willing to react, which is a tough situation. Which is why you alluded to it just before, that the Dow is doing better than the S&P, and those are the stocks, the non-tech stocks, the more defensive plays, which tend to be a bit overrepresented not overrepresented. They're represented differently in the Dow Jones than they are in the S&P 500. Those stocks are doing better. Consumers, even though I said consumers are weakening, consumer staples tend to be doing well. Consumer discretionary is not so good. In general, right now, this is an environment either to lighten up, raise a little cash, which considering the cash is still paying you 4% is not a terrible place to be. But if you want to stay invested, you may want to move a bit more toward low beta stocks and high dividend stocks because they're a little more insulated from the market's risk off mentality right now.
Yeah, it's a great point, Steve. And I wonder how that impacts positioning when it comes to those large cap tech stocks. It feels like we're asking investors to break up with their stable boyfriend from the past 2 years that's given them double-digit gains. So what are they supposed to do?
Well, that's the problem is people are reluctant to do it. And we see among some of our customer numbers, which let me be very clear, I have very limited visibility into our customer activity for for reasons that are good for the customer. But what I can see is they're still not breaking. A lot of our most active customers are not really breaking up with that good boyfriend they've had. We continue to see net buying in things like Tesla. We've seen it in basically most of your Mag 7 names. I mean, among the 25 most actively traded names. When I looked yesterday, 24 of them were still to the buy side over the past week. So, I do have to wonder whether buying the dip, which has been a phenomenal strategy for a lot of people, particularly in the last few years, but it's a strategy that's worked, probably for thousands of years. You do have to wonder a little bit, at what point does it become sort of more of a trying to catch a falling knife than it is, buying a dip? Because you do want to buy dips when the trend is in place. You don't want to buy dips when an uptrend is not in place. That's actually when you sort of try to flip the opposite mode, and that's sell rallies and then buy the dips. So it's tough to say when a trend has definitively changed, but I do get the feeling that some of the uptrends are at least, if not changing, they're taking a breather right now.
And Steve, I want to end on one trade that I really associate with you, and that is buying volatility. In this environment of such uncertainty, how are you sitting with that trade today? Should investors be thinking of owning more volatility?
I think I just basically said don't always buy dips, but that's one thing I think right now you do want to be aggressive at buying dips. What you see with VIX and other volatility measures is, they have their ups and downs, and they've shot up higher recently. I'm not sure that volatility here is a great buy at 21, but when if it starts to come down to 16, 17, and you don't necessarily feel that the risk mentality is completely changed in the market, that's a time to start thinking about adding volatility to your portfolio. I also never think it's a bad idea to think about protective hedges, downside puts, that sort of thing. Again, they've gotten a bit more expensive, but they're not, at least in individual stocks, they're not necessarily prohibitive. And so that's something else to be considering. But that's got to be on a very specific case-by-case basis.
All right, Steve Sosnick, thanks so much for hopping on with us this morning. Always appreciate having you.
Great to see you, Maddie.
Thank you. You too. Coming up, we're going to take a look back at February, including the member of the Magnificent Seven that's on pace for its worst month ever. We'll get you that stock next. It's now time for some of today's trending tickers. Scan the QR code to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, shares of Tesla slightly higher this morning, up nearly 1%. Despite that, the automaker is on pace for its second worst month ever. Out of the 19 trading days for the month of February, Tesla has so far ended lower on 14 of them, notching losses of near 30% for the month. Now, Tesla notches a 7th straight day of losses. It would match its longest ever losing streak. As a reminder, Tesla's worst month was back in December of 2022. That followed CEO Elon Musk's acquisition of Twitter. It's now X. Investors are currently worried that Elon Musk's focus on the government sort of mirrors the way he was distracted with that Twitter purchase. And in an interview with Yahoo Finance, Ross Gerber, he's a longtime Tesla shareholder and CEO of Gerber Kawasaki Wealth and Investment Management, he said Musk might have become a problem for the company. Take a listen.
But the truth is people identify with their vehicles and people don't want to identify with Elon Musk. And unfortunately, they take that on Tesla. And so it's been a tough year for Tesla shareholders. And I don't see it getting better because it's still trading at over 100 times earnings.
And we should also mention that those EV sales in Europe are also part of what is driving some of that downward pressure on Tesla stock. Taking a look at the consumer discretionary stocks for the week, Tesla is the worst performer, but another automaker is the best performer of that basket in the week to date here. You've got General Motors up 5% on the week. That, to me, goes to show that it's not all about policy coming from the Trump administration. You would think that potentially auto tariffs would weigh on a stock like GM, but their dividend and share buyback announcement was enough to get that stock up on the week. Meantime, again, you've got Tesla down nearly 17% over the last 5 days. Of course, we'll see how they do heading into the close. Shifting gears here, a commodity we are watching: gold, the precious metal on track for its worst week of the year as concerns over President Trump's tariff plans, with those 25% tariffs on Mexico and Canada and an additional 10% tariff on China, are set to take effect on March 4th. Joining me now with more, Yahoo Finance's Inez Ferre. Inez, what's driving this pressure on gold?
So, Maddie, you have a couple of opposing forces here. You have the tariffs issue, which the tariffs issue is definitely weighing on gold because this strengthens the U.S. dollar. So if we take a look at where the U.S. dollar is today, it's sitting up above 107. When the U.S. dollar goes up, typically gold goes down. So we are seeing gold under pressure today, down more than 1.5%. So this is now snapping an 8-week rally for gold because now gold is on pace for a weekly loss of about 3% over the last 5 days. But look, gold has made 9 record highs in February. Year to date, it is up more than 7%. A correction was overdue, some analysts are saying, because you had gold rallying 27% last year, almost 27%. Then you had these record highs this year. But so this was a little bit overdue, but that's not changing the base case for analysts, which are seeing gold that is supposed to hit $3,100 per ounce, according to Goldman Sachs, by the end of this year. And you have that economic uncertainty. So if yields start coming down, if the Fed does this year cut rates, that will be bullish for gold because gold does better in a lower interest rate environment. And overall, tariffs are still protectionist, and so central banks have been flocking towards gold. You saw last year a record amount of central bank buying, with the fourth quarter really accelerating, and all of that being led by China. And you've had ETF inflows, except that's been reversing over the last week or so. But nonetheless, that doesn't change the base case for a lot of analysts that are saying that that you are going to see gold going higher, but this is certainly a dip, an air pocket, so to speak.
All right, Inez, thanks so much for breaking that down for us. Certainly a commodity that investors have paid a lot of attention to and has led to a lot of people making money. So interesting to see those losses there. But let's take a look over at the stock market here. You've still got the S&P 500 moving to the upside, though. It looks like the Nasdaq has flipped into positive territory, and you've still got the Dow moving to the upside as well. Now, all 3 major averages are set to close out February in the red. Joining me now with a look at the past month and what the market may bring in March, it's markets and data editor, also co-host just host, not co-host, of Stocks in Translation, Jared Blickery. Sorry about that, Jared. Take it away for us this morning.
I've got some help, and you've helped me as well, so I'm very appreciative here. Let's take a look at the S&P 500 in the month of February. Only 19 trading days this month. Usually you have 21, but it's a short month. But not the best results. You can see down 2.7% over those 19 days. Nasdaq was down more, but we're going to focus on the kahuna here, the S&P 500, because we've been tracking seasonality estimates using data going all the way back to 1928. And although the month of February ended up a little bit to the downside, it wasn't a surprise. We kind of expected a rise into the middle of the month and then a fall, and that's actually exactly what happened. So here is our S&P 500 2025 seasonality map, which I've shown before. What's new is updating in green here what has actually happened. And this is so closely tracked the back half of February that you almost can't see. Those lines are overlapping here, but we are back down to zero. So in fact, as we sit here, the S&P 500 down less than 1% on the year. So then what happens in the month of March? It's basically this little slice in here, and yes, we blew it up for you, and we have two seasonality maps. So this is the white one is a continuation of what we were just watching, and that's one that has worked really well this year. That sees a rise in the early part of March, only to decline into the half, a little bit later than the half, and then a rise into month end, but critically ending a little bit negative there. Now, this is the same day of week method that I've been using, and this goes back to 1928. So for instance, today is Friday the 28th of February. We would only use those dates in this calculation going all the way back almost a century. Now we have another way of doing it. This is a more common way. It's a little bit easier, and so this is going to be probably more what you see from some of the other analysts out there. But this is the average in green since 1990. What this shows as a potential is a dip into about March 10th, March 12th, and then a rise into the end of the month with a few squiggles there back and forth. But for the most part, that's a more desirable outcome. So we'll have to see what happens here. But again, the white has been tracking what we've been doing pretty closely in the month of January and February. So here's the whole year again. Just want to show you that in April, the clouds start to clear. We have a few zigs and zags in the summer, and then we get into prime time volatility season in the later part of the year in October and November. We see some potential headwinds there, but I want to couch this and say seasonality is only a tendency. It accounts for up to 1/3 of price action, and we can see things override it. We have a lot of catalysts this year that could potentially do that, but we got to pay attention when things work, and we'll have to see how this works out in the month of March now.
Yeah, we certainly will, Jared. Thank you so much for breaking all of that down for us. We appreciate it. As we head to break, I want to take a look at shares of Intel on reports from the Columbus Dispatch that the chip company is delaying its Ohio chip plant until potentially 2031. Now, this comes after the company received $1.5 billion in federal funding back in November of 2024. That was after a 2-year-long stalemate with the government. That facility was expected to be operational by 2030, which was already 6 years behind schedule. Now that looks to be behind schedule again. The company promised the Buckeye State at least $20 billion for a semiconductor manufacturing plant that would create tens of thousands of jobs. Yet thousands of union workers have been waiting to continue that construction. You can see shares of Intel up over nearly 4.5% this morning. It is one of the best performing chip stocks of the week. And I also want to mention that we've got the Nasdaq flipping into positive territory right now. Intel is the 3rd best performing member of the Invesco QQQ ETF that tracks the Nasdaq. So it's interesting to see that outperformance off the back of this news of that plant still continuing to face more delays. We'll be right back here on Yahoo Finance with more markets news that you need to know. Stick with us. Fears of a recession growing on Wall Street as data starts coming in below expectations, indicating a potential slowdown. Joining me now, Neil Dutta, Renaissance Macro Research Head of Economic Research. Neil, great to have you. I know you say that much of what we see in the financial press, like tariffs, uncertainty, you call that a red herring for an economic slowdown that was already in motion. So what do you think is driving that slowdown?
Well, thanks for having me on, Maddie. I think it's primarily a function of monetary policy being too tight. I don't think people are pulling back, signing contracts on new and existing homes because they're worried about tariffs. I mean, think about that. So we know that new home sales have softened. Pending home sales are at new lows. Those represent signed contracts. And so that probably bleeds into residential investment over the next couple of months. And I think it'll in turn also weigh on residential construction activity, of course. And then when you think about incomes, I mean, the labor markets have been slowing for a while. If you look at quits rates, they have been low. Recruiting intensity has been low. And so inevitably, that's going to lead to weaker income growth. We're seeing that. And while DOGE and tariffs and all the rest of it gets the most attention, the truth is that state and local government spending and investment's been slowing for some time now, and that's projected to continue to slow into the next fiscal year. And that had been a major source of growth up until recently. So, to the extent that tariffs matter, I think that adds to the anxiety, but I don't think it's the principal cause of the anxiety.
So where does this leave our economy? How likely is a recession, in your view, for this year?
Well, it's hard to pencil in the recession call because the Fed has so much ammunition to deal with a meaningful economic slowdown. Mm-hmm. But it doesn't mean that you can't see a growth scare. So I think recession risks are rising, but I think once the Fed gets on the right side of the eight ball, those recession risks will decline. I mean, it's not unlike the period between June of last year and September of last year. If you recall, I mean, the Fed went peak hawkish in June, and then 3 months later, they're cutting 50 basis points. But I also reject the premise that the markets are actually really, I mean, this is not a growth scare trade, okay? Mm-hmm. I mean, this is largely just a momentum unwind. I mean, a lot of the winners are now being punted. If it was a real recession story, I mean, you'd expect financial stocks to be underperforming. You wouldn't see Europe outperforming. And there's a lot of things going on that are not really consistent with the growth scare. But what it does suggest, I mean, it's just another sort of notch on this idea that people are just trying to rationalize ex post something that was going on anyway. So they're trying to trying to fit a narrative to the data. But, I think if you peel back the onion, it's not really a recession story. To the extent that that's still out there, that means that there's more downside to the markets because that hasn't really been priced in. So I reject the premise that this is a recession fear story. This is a momentum unwind story more than anything else.
And I hear you when it comes to the impact of policy, but when I interview CEOs, they're all telling me that they're holding off on things like hiring, investing in the company, because they're waiting on clarity about not only tariffs, but the sequencing of policy, whether or not we're going to be getting the negative impacts of tariffs before the positive lift of those tax cuts. Do you completely discount the impact of those policy shifts?
Maddie, when things are going well, it's my growth strategy. When things are not going well, it's the economy in Washington, D.C. What did they think they were signing up for when they donated money to this guy's campaign?
I think they thought they were signing up for gains.
He ran on tariffs. He ran on that being his most favorite word in the dictionary. Now they're all surprised that he's going out and doing it. I mean, give me a break. It's just ridiculous. And also, more importantly, uncertainty would be high regardless of who was in office because the Congress would have been evenly divided anyway. So I mean, would they be holding off if Kamala won and there was a potential tax cliff at the end of the year with corporate taxes going up substantially? Right. So it's, it's sort of like crocodile tears in my opinion.
No, I understand and take your point on the policy positioning on either side of the aisle there, though I do wonder where that leaves investors if they are to follow your view that this slowdown is coming and that it's an unwind of the momentum trade. And I know you're an economist, but how should investors be thinking strategically about their positioning in this environment?
I think the way you should be thinking about this is trying to tune out the noise from DC and focus on the here and now. And what that means, in my opinion, is that the main risk to the economy is a passive tightening of monetary policy. Right now, the Fed seems to be playing a game of chicken with the administration. They're holding off on doing anything because they want to wait and see what happens with DC. At the same time, they've already been overestimating the strength in the economy. So there's a risk that by sitting back and waiting, and not doing anything, they're basically watching the economy slow down needlessly and not stepping in to stop arrest the slowdown. If you have a passive tightening of monetary policy, that'll put further downward pressure on economic growth and should push investors to take more defensive positions in the equity markets, in my opinion. That might mean consumer staples, maybe utilities. I'm not an equity market strategist, but that's sort of how I'd be thinking about it. And also to take long positions in the Treasury market, because ultimately I think the Fed will do the right thing, but there could be some pressure between now and then.
What is your outlook for the Fed this year?
I think they'll start cutting in June, and I think they'll end up doing more than what's priced into the markets at the moment.
And what do you think will be the catalyst for those cuts?
Weaker nominal growth. It's going to be very odd for them to maintain the same baseline of 2 rate cuts if they're revising down GDP growth and inflation at the same time.
So you anticipate a slowdown in that GDP growth coming sooner than the market might think?
It's already happening. It's already happening. Real personal consumption declined 0.5% in January. It's going to take a lot in the next couple of months to make up for that. Housing is still slowing, and and government spending is slowing. So remember, consumption and government were the 2 reasons why GDP sort of did really well in 2024. So how you think about those 2 things are going to have important sort of implications for how you think about this year. And real incomes net of transfers rose 1.5% over the last year. That's half the pace of consumption. So it just tells you that a lot of the driver of consumer spending in recent, over the last year has just been a drawdown of the savings rate. It's not sustainable. And as I mentioned, state and local governments are pulling back. So, that is going to prompt, I think, ongoing downward revisions to economic GDP expectations.
And really quick, as we end here, Neil, I want to get your take on the labor market. I know you see it weakening, but for those people looking for jobs who are listening and feel like the market's just been in a holding pattern, what do you think is going to cause that bigger crack in the labor market this year?
I think look, if you have a job, things are okay. If you're looking for one, things are not so good. And I think that's the challenge. If you think, unemployment, a lot of what's going on the unemployment side is really, it's taking longer for newly laid off people to transition into work.
Right. And,
that's why you have this kind of linear increase in the unemployment situation. Now, if there have been, at the margin, it does feel like layoff announcements have been going up. Even irrespective of what's going on with Doge. Starbucks, you saw Southwest Corporate laying people off. Autodesk reported layoffs, or job cuts are coming. So at the margin, it does feel a little bit worse. And I think the risk is that, if you get some modest increase in layoffs, you can get some pretty weak employment reports at that point because the hiring numbers are so weak, right? So it doesn't really take much in the way of layoff increase to kind of precipitate much weaker employment data.
Neil, I love that description of the job market. If you have a job, things are, well, okay. Neil, thank you so much for joining us this morning. Really appreciate it.
Thank you, Maddie.
Investors, they're bracing for a busy week of commentary from the Fed following the latest inflation reading. Now, this comes after the Fed's preferred inflation gauge, core PCE, came in line with expectations, showing inflation rose at a modest pace in January. Yahoo Finance's Jennifer Schomburger has a closer look at the Fed speak on deck. Hey, Jennifer.
Good morning, Maddie. Happy Friday. That's right. A better reading on the Fed's preferred inflation gauge this morning should offer some relief to Fed officials after an inflation reading earlier this month on a different measure raised questions about whether inflation was heating back up again. The question now is, will inflation continue to fall? This week, we heard from Richmond Fed President Tom Barkin and Kansas City Fed President Jeff Schmidt, who both offered lessons from the 1970s, where if you back off inflation too soon, you can allow it to reemerge. There's also uncertainty about whether tariffs could add upward pressure to inflation, and uncertainty just around the tariffs themselves and whether that could weigh on growth, a major reason why Fed officials have opted to hold rates steady for now. Tonight, we will hear from Chicago Fed President Austin Goolsbee. He will speak quite late here on the East Coast at 10 p.m., speaking on productivity growth and monetary policy. Then next week brings the last week of Fed speak before officials enter their 10-day blackout period before their 2-day policy meeting on March 18th and 19th. Monday, we will hear from St. Louis Fed President Alberto Mussolem. Tuesday, New York Fed's John Williams and Richmond Fed's Tom Barkin both speak. Thursday brings Fed Governor Chris Waller and Atlanta Fed President Raphael Bostic. Friday rounds off the week with a slew of speakers. New York Fed's John Williams again, Fed Governors Bowman and Kugler, and the big one, Fed Chair Jay Powell. Fed officials widely expected to hold their benchmark interest rates steady at their policy meeting on March 19th. The bigger question, Maddie, is whether they scale back the 2 interest rate cuts that they have penciled in for this year amidst all of this uncertainty. Back to you.
And we're certainly going to be monitoring that dot plot to come as well. Jennifer, thank you so much for joining us this morning. Appreciate it. Coming up, fresh tariffs on Canada and Mexico, plus a new levy on China set to take effect this upcoming Tuesday. We'll discuss the latest negotiations and consequences to come right here next on Catalyst. Stick around. China has vowed retaliation against President Trump's extra tariff threat. A spokesperson for the Ministry of Commerce warning China will take all necessary measures to defend its own interests if the U.S. moves ahead with that additional 10% tariff on the nation. Trump confirmed Thursday that the extra levy on China, along with that 25% tariff on Mexico and the other on Canada, will go into effect on Tuesday. Joining us now to discuss, Mark Bush. He is professor at Georgetown and former trade advisor to the U.S. Department of Commerce. Mark, it's great to have you on. I just want to start on Mexico and Canada, and I wonder how you're reading the tea leaves here. The market would love to see those tariffs come down from 25% come Monday and Tuesday of next week. Do you anticipate that?
I think he's going to invoke the tariffs on Tuesday. He more or less has talked himself into a corner, and for a number of reasons, I fully expect that we will see the tariffs on Canada and Mexico go in. And I seriously doubt that anything can be struck between now and then to give Canada and Mexico another 30-day reprieve or even longer.
Well, that's interesting in the context of what we saw with the UK Prime Minister this week, who did have some success negotiating. And I want to take a listen to some sound here and then get your thoughts on the other side from this conversation.
Mr. President, did our Prime Minister persuade you not to put tariffs on the UK?
He tried. He was working hard, I'll tell you that. I think we could very well end up with a real trade deal where the tariffs wouldn't be necessary. We'll see.
Okay, so Mark, he was willing to potentially say that he's ready to make a deal with the UK. Did the UK have a playbook that Mexico and Canada should be copying here?
No. And the reality is that there are a couple of really interesting terms that the president uttered. First of all, I'd love to know what he means by a trade deal. Sounds like he wants something very narrow, and that is certainly not what the UK has wanted for many years now and was denied under the Biden administration, despite offering the US everything it could possibly have ever wanted. So I seriously doubt there's any lesson for Canada or Mexico, given what we just heard. But for Trump, it's going to be much harder to impose tariffs on the UK than it is given the narrative that he used to invoke the International Emergency Economic Powers Act against Canada, Mexico, and China. So I think the UK has less to fear, but I seriously doubt that the UK Prime Minister is going to head home thinking that he got something to settle his nerves and he won't have to worry anytime soon about forthcoming tariffs.
Fair enough. It's also interesting in the context of a post from the president on Truth Social this week talking about the severity of his focus on tariffs in the context of what's going on with the tit for tat with China. Do you expect any negotiating to happen with the U.S. and China moving forward on these tariffs, or is it going to be a continuation of this tit for tat?
I think it's great that China reached out to the newly confirmed USTR ambassador, Jameson Greer. That's certainly a sign of some goodwill. But no, I don't expect much negotiation. I expect that China, Canada, and Mexico will begin to firm up their retaliatory lists, despite the fact that, keep in mind, in the executive order, there is an escalation clause that President Trump inserted such that in the event that Canada and Mexico in particular were to retaliate, these numbers will not stay at 25%, and we will have an all-out trade war. And the retaliatory lists are not limited with respect to tariffs. Both Canada and Mexico are getting highly creative and threatening to take this in a very un-Canadian, un-Mexican way going forward. They are potentially going to invoke non-tariff barriers and do it in a very dramatic fashion. So look for this to escalate if, in fact, we see the tariffs go into play on Tuesday, which I expect we will.
And moving forward here, Mark, what investors really want to know is whether the brunt of the impact of these tariffs could potentially be softened by those upcoming potential tax cuts. What do you think of that, in your view, the kind of teeter-tatter between those two catalysts for the market?
It's really an unbelievable question if you think about it. The idea being that somehow he can compensate for the economic damage that he knows he's causing. So it would be great if President Trump were inspired to be a real pro-growth president and give us both no tariffs and tax cuts. The idea that these tariff salvos are going to generate enough income to replace or substantially reduce income taxes is bizarre, and certainly the math doesn't bear that out. But no, I don't expect that we are going to see some compensatory mechanism fully relieve us. And keep in mind, the damage has been done. The damage of these tariffs has already been done. They've seeded tremendous uncertainty. They've created a sense that the United States is no longer a trusted trade partner. And if I'm the UK Prime Minister flying back home, my first thought is it even worth the candle? What is a US trade deal if the obligations can so readily be thrown out the window? So the damage has been done. Investors have two fears. One is the number that the tariff comes in at, and the other is the uncertainty. The uncertainty is now going to be with us for a very long time.
All right, Mark, thank you so much for joining us this Friday morning. Really appreciate you breaking that down for us.
Thanks for having me.
Well, consumers and companies are bracing for the impact of President Trump's potential tariff policies. Trump confirming those additional tariffs on China will go into effect on Tuesday, alongside 25% tariffs on Mexico and Canada. The uncertainty already weighing on many Americans, causing consumer confidence to fall to the lowest level since August 2021, and pessimism about the future to reach a 10-month high. So how can businesses and consumers prepare for tariffs? Joining me now, we've got Andrew Siciliano, the leader of U.S. and global trade and customs practices at KPMG. Andrew, thanks for coming on set with us. We appreciate it.
Maddie, it's great to be here.
So talk to me about the single biggest takeaway for you, just in terms of how much leadership is concerned about tariffs right now. This is something we've been debating a lot this morning, whether or not the market cares about tariffs, whether or not CEOs care. How much do you think it's weighing on sentiment?
It's a significant concern. I mean, it feels like tariff uncertainty is the new normal right now. The president's only been in office for less than 40 days. We've had countless announcements on different tariffs from different countries, different products. So it remains to be seen. I was on a panel this week with a bunch of CFOs, and the comment that was made, I can't prepare for the long term when I don't know what the short term is going to yield. So we're at a point where it's the calm before the storm, and the storm may be coming next week, but we're still in the wait and see mode. The 10% China tariffs are the only real tariffs that have been implemented as of today. There's more to come. Not only in March, but in April, there's a slew and onslaught of potential more tariffs. So, like I said, the uncertainty is the new normal, and companies are still trying to brace with what to do. Tariffs policy is changing overnight, but supply chains don't.
Right.
So they can't really make any moves right now. It's a lot of wait and see. But some of the better companies are doing a lot of proactive planning.
Yeah. Let's go there. What are you seeing businesses do to prepare for those upcoming tariffs effectively?
Yeah, that's a good question. So it's really a big mix. The best companies that are handling this are the ones that have embedded trade strategy into their business model. They have chief trade officers, they have systems, they have data at their fingertips. So let's talk about data. I can't underestimate the importance of technology. Some companies don't even know what they pay in tariffs globally and can't determine the impact immediately. So what prudent companies who were ahead of the game on this, they have that data at their fingertips. We've been helping a lot of companies with a platform called Digital Gateway. We get all their trade data. As these changes are announcing, real-time impact analysis, looking at their data. So that's really, really important. You can't determine the impact if you don't have the data. Also, companies that have a diverse supply chain, being able to make those changes and monitor where you could go next if there is a huge tariff on a certain product. And then lastly, tariff optimization programs. There are a host of programs that companies could consider, if done properly, could really mitigate the tariff. So I could go on for a long time about that, but just to name a few, there's something called first sale for export, where you could pay tariffs on an earlier sale if there's multiple sales in the chain of transactions. Very popular program. It's only available in the United States, which is really pertinent right now for a lot of companies. So companies that never really paid tariffs before, in 2018 started implementing the first sale for export, and now a lot of companies are looking at it even more. Foreign trade zones. A foreign trade zone is an area outside of the customs territory. So just think about the potential impact of Canada and Mexico and the goods that are moving across the border. Sometimes an auto part, for example, could cross a border multiple times, right? So if you have a foreign trade zone that's outside the territory, those goods could move clear and free across borders without any impact. Another area is valuation. The tariff is assessed against a value, and sometimes that value is just the price paid for the goods without a lot of thought of what's really in that value. And what makes it even more complicated, when you have a related party transaction, that value is set by a transfer pricing team. So we work really closely with our transfer pricing team to make sure we're not, don't have a value that's too high for our clients, and they meet both the tax and customs rules.
All right, Andrew, we got to leave it there. Thank you so much for joining us. Andrew Siciliano over at KPMG. Thanks so much.
Thank you, Maddie.
Appreciate it. We'll be right back.
clear that the CFPB suffers from a crisis of legitimacy. This must be corrected if the CFPB is to reliably do what it's supposed to do, look out for the American consumer. To that noble end, the CFPB needs to be made accountable to our elected officials, and its past excesses need to come to an end.
That was President Trump's nominee for head of the Consumer Financial Protection Bureau speaking to the Senate Banking Committee yesterday, pledging he will follow the law and execute functions required by congressional statutes if confirmed as head of the agency. Despite that, employees of the agency claiming Elon Musk, Doge, and the Trump administration planning to fire the majority of the agency's 1,700 employees. Staff say that Doge and CFPB leadership met this month to discuss 3 phases of those layoffs, which you can see on your screen here. Moving forward here, we are speaking with Rohit Chopra, former head of the Consumer Financial Protection Bureau under President Biden. Rohit, great to have you on here. I want to jump in because we don't have a ton of time left. The Trump administration has cut back on the CFPB, shutting down offices, laying off staff. What is your biggest concern?
Well, I'm really worried about this effort to defund all of the police that look after Wall Street and big tech. You know, yesterday we heard that the CFPB essentially issued a series of corporate pardons, including to big companies like Capital One and a Berkshire Hathaway subsidiary accused of illegal lending. So there's big questions right now as to whether the market is going to shift on from meaningful competition to really figuring out how to bend the rules, cheat, and sidestep accountability.
And what do you think consumers need to know about the risks to them personally with these scale backs, especially given that under your purview in the CFPB, you were tough on enforcement, and now it seems that things are moving in the opposite direction?
Well, a lot more is going to shift to individual consumers where there are so many scams, there are so many ways in which our personal data is being heisted, essentially. So I don't have good advice other than to say, why on earth would we want a situation like this? President Trump actually campaigned on capping credit card interest rates, which I agree have really gotten out of control and are not really based on market interest rates or risks. It just seems almost predatory now. But instead, Capital One is getting a pardon, and the law enforcement agency that oversees the credit card industry is essentially being benched and sent home.
I know that you were also the FTC commissioner back in 2018, which of course was under President Trump's first term in office. What can you tell investors listening about what regulation might look like under Trump 2.0?
It's really interesting. I think a lot of investors are really scratching their head right now because I think they were really focused on a different regulatory environment where maybe certain things would be less stringent. But now what they're facing is just lots of chaos and questions. We're seeing a lot of indicators, not just consumer confidence, but business decision makers not really know, are we really heading into more uncertainty and fragility for the economy? So I think investors really have a lot to work through, and my hope is that there is not going to be a marketplace that incentivizes scam artists and fraudsters rather than honesty and competition.
All right, Rohit, we have to leave it there, but I really hope you'll come back with us and we can talk a little bit longer because we'd love to get more of your insights, especially about big tech coming into Washington. So thank you for making time for us this Friday morning. We appreciate it.
Thanks again.
Coming up, we've got Wealth dedicated to all of your personal finance needs. Brad Smith has you for the next hour. I'll leave you with a quick check on the broader markets here. You've still got the S&P 500 and the Nasdaq in positive territory for the day, and we're still seeing those gains coming in here across the board, really looking like February might be on track to get out some gains before the end of the trading day. Have a great weekend.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's time for Yahoo Finance's Market Minute. Stocks are higher on the final trading day of the month. Still, they're poised to end February lower. Palantir slipping again, with shares now off over 30% since hitting a record high on February 18th. There are different reasons for the selling, including reports of possible U.S. military spending cuts. Stock is still up around 245% over the past 12 months. Shares of Dell falling on a mixed outlook. The revenue forecast for the PC maker's current quarter came in below estimates, while its full-year forecast topped expectations. Still, Dell is optimistic about the outlook for AI growth. And Rocket Lab shares, they're rebounding from earlier losses. Record sales in its fourth quarter, offsetting a disappointing first quarter outlook and delayed launch. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Nvidia falling out of the $3 trillion club. We discuss what the chipmaker's declines in 2025 so far mean for CEO Jensen Huang's wealth. And egg prices. We'll discuss the strain on your wallet and what the Trump administration plans to do about it with the CEO of Vital Farms. Plus, getting retirement ready. All week, we've been taking a look at how to best invest for retirement at every age, from workers in their 20s maxing out that 401k match to those over 70 living off of their investments. Today, we focus on your 70s and beyond. making your money last. All that and much more coming up during today's show. But first, as we always begin the hour, let's take a look at some of the top market action here that we're tracking 90 minutes into the trading day, on a day where we got some fresh PCE, personal consumption expenditures data here on the economic front, the Fed's preferred inflation reading here. And there we're taking a look at some of the market movement here now 90 minutes into trade, as major averages are all fractionally higher across the board. This is also the final day of the month, final trading session as well. And the Fed's preferred inflation gauge, we mentioned, that was in line with expectations today. Joining me now, we've got Liz Miller, who is the CFP and Summit Place Financial Advisors founder and president. Liz, you say boring holdings are a valuable part of any portfolio, especially during the recent volatility that we've seen. So walk us through what you mean by that, and where are you looking for these so-called boring holdings?
So, of course, we're always talking about investors having a diversified portfolio. But certainly the last year, we know there was that temptation to just own lots of the high-flying AI stocks, lots of Nvidia, even lots of Microsoft. You were just noting that we see some of those under some short-term pressure. But it certainly has been an uncertain market. And to my mind, that's when that full diversification comes into play. And I talk about the parts of the portfolio that felt boring over the last year or so, like a healthcare holding or a food and beverage kind of holding, which really weren't participating in last year's strength.
So all of this in mind, we got some fresh economic data here this morning. Want to get your read through on personal consumption expenditures, especially how that carries through to how investors are thinking about the consumer as it relates to the economy and the Fed's dual mandate.
Sure. Well, we need to start with the income part that came in this morning, which showed that incomes were growing. Personal income was up, in line with expectations, but growing. And then personal spending for the month was down, and that was a big miss. And I think there's two components to that. The pure economist in me needs to say, well, we had some weather, and that might have distorted that number, and so we need to watch it for the trend. But I also think it's really reflecting exactly what we're seeing in this market, which is just this sloshing uncertainty. We get a little bit up, a little bit down. Investors and consumers, same people, really aren't sure where we're going and want more visibility on what the direction is before they open their wallets some more.
Certainly. And so as you're looking for some of that visibility, where do you think that visibility comes in the form of at this juncture?
At this juncture, I really think it comes from policy out of the White House. Now, we know, and we knew coming into this year, that President Trump's policies often look very different from the early discussions. And we're all just getting used to that again and figuring out how does that get reflected in the market. The truth is it takes a lot of patience, which is kind of surprising, because when you think about our president, you think about someone who wants to be very action-oriented. But as an investor, you really have to sit back and wait to see what kind of policies we're really putting in place.
And so as we're waiting for those policies to really be clarified, who are some of your top picks in your portfolio management strategy right now?
So I'm going back to what we call those boring stocks, like Johnson & Johnson, a wonderful long-term holding. The stock has sort of traded in a range for a couple of years. The fundamentals are fine. And I think that's one of those places where you can be buying today and you're going to get some stability through a market like this. I also talked about kind of the food and beverage players like a Coke. Coca-Cola hadn't done things for a while. We did get a bit of a boost up and down last year, but very quietly, this is a company that really does keep adjusting to trends. It's not just selling sugary sodas. And again, I think this is one of those holdings that it may not be where you think a lot of the future growth comes from, but these kinds of diversification in your portfolio play an important role.
Liz, thanks so much for taking the time here with us today. Really appreciate it.
Thanks.
It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got Yahoo Finance's Julie Hyman, host of Market Domination. Julie, we got to know, first up here, Microsoft. What is going on there as they're shutting down Skype in May? That's the big talk of the town.
Pour one out for Skype, right? That video call platform, it's going to be shut down on May 5th. Now, I don't know about you, I haven't even heard about Skype in a while.
Really?
I mean, like, when's the last time you used Skype?
No, that's fair.
Right, so it makes sense that they're shutting it down. And I've seen some pretty dramatic figures online about the market share declines it's seen over the past year. I mean, I can say anecdotally here at Yahoo Finance, we first used Skype as our primary platform once the pandemic sent us into remote broadcasting. But maybe it was a little buggy, and maybe others found the same thing. Microsoft bought Skype almost 14 years ago. Remember, it was started by a couple of entrepreneurs in Northern Europe. eBay owned it at one point. Then it was sold to a private equity consortium. It peaked at more than 400 million users. But now Microsoft Teams has 320 million users. So that's really been the thing that Microsoft has put its bet on rather than Skype, obviously. The latest figures I saw put Skype at somewhere under 40 million. So it's really had a very dramatic drop off here. Steve Ballmer's the one who bought it for Microsoft at $8.5 billion, which was a 40% premium at the time to that privately held internal sort of valuation. So, it looks like it's going to. It doesn't really make a financial difference. It doesn't seem like to Microsoft at this point.
It also speaks to how well, though, that they've integrated other video conferencing and video messaging systems into their own ecosystem for Microsoft, whether that be for peer-to-peer or whether that be for business user to business user on a kind of corporate scale there.
Yeah, it's mostly Teams, right?
Yeah.
It is mostly Teams on the enterprise level that has replaced it. Teams, sort of the big competitor to Slack in that way in terms of messaging and in terms of video. And then on the consumer level, I mean, WhatsApp, WeChat, FaceTime, Zoom for both corporate and personal use. There's just a lot of competitors out there that sort of forged in the fire of the pandemic. That's really when they started to gain a lot more steam.
Yeah, absolutely. Another big name that we're tracking within the tech landscape this morning is Intel. Intel reportedly delaying its $28 billion Ohio chip plants. The first factory in New Albany is now expected to be completed in 2030. That's according to the local media outlet, the Columbus Dispatch. The factory will begin operation sometime in 2030 or 2031. It was originally scheduled to begin operating this year. We know what has happened. Intel's second Ohio factory won't be completed until at least 2031 here. Shares still up on the day by about 3.5%, but long lead time here.
Yeah, a little, I guess you could call it a bounce back. I mean, the shares are down something like 40% over the past year, and we have seen a tech sell-off more recently, but this is part of the bigger existential struggle at Intel, right? Intel, the chip maker, which has tried to, or did try to under Pat Gelsinger, go back to its roots as also a chip manufacturer, a so-called fab or fabricator of chips, and has tried to build up these manufacturing operations not just for itself, but also a so-called foundry, a merchant foundry building chips for others. And that's really the part of the effort that has drawn the most questions from investors and really is part of what led to Gelsinger's ouster as head of Intel. So now you go back to this factory here. The company got funding as part of the CHIPS Act to build out this thing. Originally was slated for this year. Then that sort of started to creep back. And it sounds like they're just going to kind of slow construction way down. This has partly to do with demand. The officials, as reported in that Columbia Dispatch, the officials in Ohio say it's still on track. It's still going to happen. We're still going to get our jobs here in Ohio. But it's going to happen on a longer timeline.
Well, the larger question here, too, I guess, is how many of the other players that already have, especially thinking about a TSMC and their inclination to want to bring more chip manufacturing and fabrication processes for those wafers to the U.S., will they be able to appease the Trump administration enough, who has essentially rolled out the red carpet for some of that foreign investment, so that they can kind of offset any of the demand that Intel would be able to take on? Of course, in Intel, they had received favor, as you mentioned, during the Biden administration as part of the CHIPS Act.
Well, and there was also some talk, remember, there was some reporting that maybe Taiwan Semiconductor would even be interested in buying some of the Intel fabrication facilities, although some analysts sort of brushed that off and said it wasn't realistic, but that's something that's out there in the ether being discussed as well.
Absolutely. Julie, thanks for breaking these down with us.
Happy to be here.
Everyone, Nvidia falling out of the $3 trillion club. The chip maker's market cap now sitting at $2.93 trillion, putting its second place rank at risk with Microsoft breathing down its neck. Nvidia was founded in 1993 by three people, including current CEO Jensen Huang. Since its IPO in 1999, shares have risen more than 250,000%, with much of the increase happening in the last 5 years. The company has led the AI boom on Wall Street. Jensen Huang has served as president, CEO, and a member of the board since the company's inception. Huang falling from the 13th richest person alive just a week ago to the 16th richest, according to Bloomberg's Billionaires Index. Still, not too shabby. He has a net worth of $102.6 billion, trailing other tech CEOs like Elon Musk, Mark Zuckerberg, and Jeff Bezos. The majority of Huang's wealth comes from his 3.4% stake in Nvidia. That shakes out to about 837 million shares, worth around $100.6 billion. The other $2 billion of that net worth is in cash and other assets. In 2025, so far, Huang's net worth has fallen by nearly $12 billion, with more than $9 billion lost on Thursday after earnings alone. Well, Bitcoin currently trading lower, but holding above the $80,000 mark right now. The cryptocurrency recovering a bit of ground after its multi-day decline, off nearly 25% from a January all-time high. I'm going to toss it on over to Brian Sazzi, who's over at Bitcoin Investor Week in Manhattan. Hey, Saz.
All right, thanks so much, Brad. Yeah, it's getting pretty noisy here at the Bitcoin Investor Week conference in New York City. Mike Cagney here with us, Figure Markets founder and CEO. Good to see you, Mike. I understand big news out of your firm yesterday. Before we get to that, Brad mentioned a real, we're seeing a sell-off in Bitcoin prices. Pretty significant. How severe do you think it can get?
Look, I think it's a natural course of the market, really finding where the near-term equilibrium is. I don't put too much stake in terms of what's happened. It's just typical Bitcoin volatility. So the fundamentals, if you look at what's been headwinds to Bitcoin for the last 4 years becoming tailwinds, it's a pretty constructive backdrop, irrespective of what's happened over the last couple of days.
For folks not familiar with your background, you built SoFi, now you're building something else, another marketplace at Figure. What does this moment feel like to you? I mean, does it feel like it's gotten more serious in the crypto sphere?
Yeah, look, I think we're at a tipping point, in particular, where we're going to see a lot of TradFi move into blockchain finally. And I always comment, the blockchain space never loses an opportunity to shoot itself in the foot. And, we had the hack last weekend, we had Libra the weekend before that. But the reality is there's a lot of people building real solutions on blockchain that have real economic value and benefit. I think with a lot of regulatory clarity that's going to come through this year, you're going to see a lot of traditional entrants, especially within the bank and financial services sector, come into blockchain in a serious way, and it's supportive for the whole ecosystem.
When you saw that Bybit hack, what did you first do and what did you first think?
Look, we run our exchange, we run decentralized MPC wallet. I think anytime you rely on a centralized custodian structure, you run this risk. And it's always surprising to me after FTX, people are still sending their coins onto the exchange. And the reality is, sort of the ultimate paradox, blockchain's about decentralization. So the fact that crypto's trading on these centralized constructs doesn't make a ton of sense. So I think it's really, as anyone who holds a coin on blockchain, self-custody, decentralized custody, not centralized custody.
Talk to us about the news out of your firm yesterday.
So yesterday we announced that we stood up a permanent capital guarantor for our blockchain ecosystem. So we've been originating loans on blockchain since 2018. We've done about $43 billion of loan transactions on Provenance blockchain, which is the level 1 that we use on the back end. But the ultimate goal was to get to a point where we could create an ecosystem that looked like Fannie Mae and Freddie Mac, that had a permanent capital guarantor that provided the ability for originators to lock in both their price and liquidity on their mortgage production. And so we took $200 million in from 6th Street to stand this guarantor up to help facilitate liquidity within this ecosystem.
I see Robinhood's public, Coinbase is public. When are you public?
I'm not allowed to say. So look, I'm very eager for Figure to be public. So that's all I can talk to.
Is the market that big to support all these exchanges?
So I think you're going to see some real consolidation. I think most exchanges are subscale, and I think also what will happen with some of the regulatory clarity, I think the two things the administration's trying to get by the August recess is stablecoin legislation and market structure legislation. I think that market structure legislation is going to have, the ICEs and the Nasdaqs of the world leaning in and trying to build a more national construct for crypto trading versus the bespoke structure that we have today. But it'll still be a centralized structure, which I'm not a huge fan of.
I want to see where you stand. So Vlad Tenev, I talked to him earlier in the week. He says no Bitcoin reserve this year. Talked to Anthony Pompliano earlier today. He thinks we get one this year. What say you?
I think it's going to be a tough one for the government to do, and I certainly think the price action of the last week hasn't helped the case.
And just to be clear, I mean, you don't think we're headed towards another crypto winter?
No,
that's not what this is.
Not at all. I think such different fundamentals. So you look at what happened in 22 with the bankruptcies and really just with a loss of faith within the crypto community. That's not what's happening right now. I think people are very bullish. They're very leaning in. I think, as I said, the developments that we're going to see on public blockchain over the next 12 to 24 months will blow people's minds. Think about how much has been accomplished and how much has been built in the last 4 years when it was nearly impossible to do anything on blockchain. The next 4 years, you're going to see real innovation, real transformation.
Well, good to catch back up with you, Mike Cagney, Figure Markets founder and CEO. It's busy in here. I mean, it feels like a real conference. Mike, good to see you.
Good to see you.
All right, guys, back to you.
Thanks, Ozzy. We'll be bringing you more coverage from Bitcoin Investor Week later today on Market Domination. Stay tuned for conversations with Wyoming Senator Cynthia Lummis and Skybridge Capital Anthony Scaramucci. That coverage starting at 3 p.m. Coming up, is the price of eggs straining your wallet? I address the costs with the CEO of egg producer Vital Farms. You see him there. We're coming to you on the other side of the break. Stay tuned. Shares of Vital Farms whipsawing after the company's 10-K filing revealed issues with its accounting practices. That pushed the stock lower after initially rising on an upbeat earnings and guidance. Shares back up, though. Stifel upgraded the stock to buy from hold, touting the company's future growth. Here with more, we've got Russell Diaz-Canseco, who is the CEO of egg provider Vital Farms here. Russell, good to have you here with us. Let's just first start with the accounting issues before we dig into the rest of the earnings here. What was at play there that the street needs to know and investors need to have some clarity around?
Sure. So the headlines are no misstatements and no restatements in the works. This was really about maturing our accounting systems in a year in which we had to shift from being an emerging growth company to an accelerated filing company. And it was all driven a year early because of our success in growing our business and therefore the valuation of the company. So this is simply a matter of maturing our accounting systems, but no issues with historically reported numbers.
Okay, and so now you've got a friend in Stifel here this morning who upgraded to buy here. They talk about some of the $44 price target, the outlook for near-term growth supported by improving egg supply, processing capacity. Just walk us through what all that contributes to the long-term growth that you're anticipating that has some investors, Stifel namely here, bullish.
Sure. So, Stifel's been analyzing and reporting on us since our IPO in 2020. And the reality is that what we've done since then is established our path to becoming America's most trusted food company. We're primarily known for our eggs, but we're bringing eggs to the market in a very different way than the rest of the industry, with a distributed model, working with over 425 small family farms, and our own world-class egg packing center in Springfield, Missouri. So we're not playing a short-term game of kind of gaming the pricing in the marketplace. People are seeing outrageous egg prices today in the marketplace. We're building a brand for the long haul, and that's resulted in very consistent growth with positive gross margins and profitability since the IPO. And I think that's pretty rare for a small, fast-growing company like ours.
And so talk to us about how you're insulating the business from the avian flu, which is certainly rattled and entirely disrupted the rest of the egg market here and driven some of this high inflation that we've continued to see within that particular part of the basket for consumers.
And I'd be remiss if I didn't call out the impact on hundreds of millions of laying hens. This company was founded with a big focus on improving animal welfare. And frankly, the real travesty here, beyond the high price at the grocery store, is that we've killed hundreds of millions of laying hens in this country. And I think a lot of it, frankly, is avoidable, as we've shown with our own model. Like everybody else in the industry, we certainly don't want to see this happen. Our small family farmers just put a lot of energy and effort into maintaining wonderful farms, great infrastructure and good repair, and observing all those top, the very best thinking in biosecurity to protect those birds. But beyond that, even when on occasion a farm is affected, we've had none affected this year. We had 4 over the last 2.5 years. None of them are more than 0.5% of our production because we have this wonderful distributed network. So we think that's a much more resilient model, both because we don't have concentrated supply and because I think when you have a small family farmer owning the farm and in most cases self-operating that farm, there's just a little bit more care that goes into it, and maybe that helps explain the vigilance that's protected our birds.
What would your advice be to other farms who are trying to navigate this?
It was wonderful to see the Trump administration's focus on this. Brooke Rollins' op-ed in the Wall Street Journal, where she talked about a 5-point plan. One of the elements of that plan is to invest, government money into helping America's egg farmers repair maybe some of that aging infrastructure that's allowing the introduction of wild animals that may be infecting birds. So I think, number one would be accept that help if you need it and get those barns repaired and maybe invest some of the profits that the industry is seeing right now due to avian influenza in maintaining the infrastructure. And hopefully that'll have a positive impact on the birds in the future.
And just to put some numbers on this, it seems like the U.S. Department of Agriculture announcing $1 billion in that plan in order for U.S. farmers, as you mentioned, to combat the impact of the bird flu epidemic that's really impacted the laying hens and thus had a larger impact on the food system as well here. Do you think that there needs to be a more regularly focused agenda to make sure that this also doesn't rear its head again, even after we've curbed the impact of the avian flu this go round?
You know, I think there's still a lot to learn about how this disease occurs. Certainly, if the answer were easy, the industry would have found it already. I think it's probably a lot of different things, a lot of vigilance, maintaining equipment and barns in great repair, a high sense of ownership, healthy hens. I mean, this is, at the end of the day, flu. And as we've seen with human versions of things like the flu, they tend to impact less healthy people more and more readily. We focus on bird health. We feed our birds, a feed and a supplemental set of nutrients that we think really kind of helps create a really vibrant, healthy bird. They go outside, they get some exercise, some sunshine. These things all add up to resilience in the bird, and that may have an impact as well.
You know, we only have 30 seconds here, but a lot of the viruses or diseases that have spread have certainly been pointed back to climate change. What other efforts would you like to see in order to combat climate change that could also help offset the risks of flu, like the avian flu, spreading among fowl?
You know, I think, whatever the future holds in terms of climate change, I think the most important thing is to have a growth mindset, as that's one of our core values here at Vital Farms, to make sure that you're resilient in the face of change, whatever may come, and that you can adjust accordingly. So that's certainly the approach we're taking.
Russell, thanks for taking the time here with us today. I appreciate it.
Thanks for having me.
Coming up, we're heading into the first somewhat warm weekend of the year, at least here in New York. So we're going to send you off with some home buying tips for those going house hunting and putting the hoodie, maybe a little over jacket on, and we'll get you prepped. That's next on Wealth. Mortgage rates declined in the last week, but remain near 7%. Elevated rates have kept buyers out of the market. Pending home sales, they fell to their lowest level ever. Lawrence Yun, National Association of Realtors chief economist, saying, quote, "It's evidence that elevated home prices and higher mortgage rates strained affordability." So, how can buyers navigate this market? Joining me now is Rogers Healy. He is the owner and CEO of the Rogers Healy Companies. Good to have you here with us. So let's start with that very question. How can buyers navigate the affordability crisis as it's been really regarded among some of the economists tracking this industry?
Yeah, I hate to be a broken record, but the same way they've been navigating it really since COVID. And I think you got to have a strike quick mentality, not to go Cobra Kai on you, but yeah, you got to be ready. And I think that, the irony is you just said interest rates have dipped below 7%, which is still kind of high compared to where it was 4 or 5 years ago, but it just proves that the market is still busy. And I know Lawrence said that, the pending home sales were down in January, but guess what? That's January. It's usually pretty slow in January. People are coming off the holidays. They don't want to spend a bunch of money. And they're gearing up. You mentioned hoodie and sweater weather. They're gearing up for the spring. And that's usually when it becomes mayhem, whether you're in New York City, Dallas, or in Middle America. So, yeah, it's kind of the same thing that we've seen the last few years, but maybe it's starting to level out just a little bit, which frankly is a great thing.
As we were looking through the rates that were published by Freddie Mac here, they also, with their chief economist, had put out a statement saying the mortgage rates decreased to their lowest level in over 2 months. If you're a buyer that's hearing that going into weekend buying, where can you kind of assess the market and find the best deals as well?
Yeah, and again, it's a catch-22. I've always been a fan of buying a house because it makes sense for you right now. Rarely is there a forever home. There's forever relationships, right? And that's what you need to capitalize on. But, if you find something that feels right, jump on it. And in most states like Texas, you have a diligence period where you can actually make sure it checks out across the board. But yeah, I think the definition of a good deal has shifted dramatically. We have 72.5 million millennials in the U.S. They're the largest generation of people in our country. They're the largest pocket of buyers. And they're going to make it more and more difficult to try to get, real money off. So find something that feels great, and that's going to be a great deal, I think, for the next 10 or 15 years.
What ways are you seeing buyers get creative in this competitive market then?
I think the most important thing, honestly, is to be realistic. Have an agent that actually knows what they're doing. They're representing you. They're not an Instagram influencer. They're actually an educated agent that knows what they're doing. Get pre-approved. If you're paying cash, have your financials in store. But just be ready to act, And I think that the dream home thing is honestly, it's a myth. And you can kind of make any home your dream home for the short term as long as you've got the right context. So yeah, find somebody who has resources, that knows what they're doing. And when you get that feeling, maybe sleeping on it is a nap and not an actual real night's sleep. And by that opportunity, you can actually see if it's yours to purchase.
So for shoppers that are going out this weekend, what tips do you have for those who are house hunting? And of course, we're a few weeks out from the real pivot to the spring buying season.
Yeah, I think, again, just trust your gut. And investing, your home is usually your biggest investment of your life. And I think among everything that can be defined with investing, it's really a gut instinct. And if you walk in and you feel like you could make it your home, then do it. Go for it. And ask for, real advice, real suggestions. And if it doesn't have the perfect color door and maybe you want different hardwood colors, have somebody help you with that, right? And I think some people talk themselves out of big decisions, and frankly, they regret it later. So yes, start looking, hire somebody that knows what they're doing, be resourceful, but also just be realistic and realize that it is an investment. Statistically, before COVID, people would live in their house for 5 to 7 years. That's changed, and that's changed in large part because of what we started with, 6.85% interest rates. When those things dip down, people are going to want to stack chips and level up. So I think we've seen, at the very beginning of some very, very busy cycles for the next 10 to 15 years.
What's the first DIY project that you often hear that potential buyers are thinking about starting once they finally get into that new home?
Simple stuff, right? The two main attractions of a home have always been the kitchen and the master bedroom / bathroom. So stuff that's very simple, countertops, paint, wood colors, all that kind of stuff is always going to be something that reminds them of where they're moving from, which is probably a rental, but they're moving for a reason. So yeah, stuff that's simple. I think that, adding on square footage is always a great idea. It's a great way to make money, but that's expensive, it's time consuming, and it's not normally that much fun. So yeah, I think that the beautiful version of lipstick on the pig is always a great idea.
Rogers.
Especially if it's Peppa Pig.
Yeah. Rogers, thanks so much for taking the time here with us today. Appreciate it.
Cheers.
Coming up, we're wrapping up our week-long looking at investing in success in retirement. Plus, we've got the changes at the Consumer Financial Protection Bureau. That's next on Wealth. Employees of the Consumer Financial Protection Bureau claim in court testimony that Elon Musk's Doge and leaders of the agency are planning to fire the majority of the agency's 1,700 employees. According to court filings, staff say Doge and CFPB leadership met this month to discuss 3 phases of layoffs: probationary and temporary workers, then an additional 1,200 workers, and within 60 to 90 days, winding down operations of the agency. The CFPB also dropped multiple lawsuits against lenders, including Capital One and Rocket Homes. Here's what Rohit Chopra, former head of the CFPB, told Yahoo Finance earlier this morning.
I'm really worried about this effort to defund all of the police that look after Wall Street and big tech. So there's big questions right now as to whether the market is going to shift on from meaningful competition to really figuring out how to bend the rules, cheat, and sidestep accountability.
All week long on Wealth, we've been discussing how to best save for retirement from the beginning to the end of your career. According to the CDC, the average life expectancy for Americans is over 77 years old, with women living an average of 80.2 years, and assuming retirement between 60 and 65, that means your retirement funds need to last over a decade. So, here with some advice for those over 70 on making their money last is Lawrence Sprung. He's the Midland Financial founder and the author of Financial Planning Made Personal. Larry, great to have you back here in studio with us. So how much should people have saved in their 70s?
So there's a lot of rules of thumb out there. One is 10 to 15 times what their most recent annual earnings were, or 20 to 25 times what their annual expenses are. Now, those are rules of thumb. You want to take a look and see if that works specifically for you, but it's a good starting place for most folks.
You recommend dividing your money into 3 different buckets. Explain what you should have in each one.
Yeah, so you don't want to have all your money designed for long-term investments, super maybe additional risk involved, but you also don't want it super conservative in case inflation starts rearing its head. So we highly suggest diversifying amongst those time frames, having some money available short-term, maybe in a high-yield savings account that's liquid, higher rate of interest, have your midterm money more conservative than the long-term money, getting a higher rate hopefully than the high-yield savings and some growth. And then for monies that may be 6-7 years longer that you don't need that for, have it in more high growth areas than income generating areas.
Now, at age 73, we know investors have to start taking required minimum distributions, those RMDs. How do you recommend budgeting those funds?
So plan for them, right? Have an idea. Don't wait till you're 73 to have an understanding of what your RMDs are going to be, because keep in mind, you have the opportunity to convert IRA money to Roth IRA money if you want, because that may end up reducing those required minimum distributions in the future. You might be paying lower taxes, but it's something you should look at and understand what the impact to your income is going to be, because there are also ancillary effects that it may have.
Taking RMDs, that can also increase your tax burden though as well. And to what extent, so how do you kind of make sure that you are offsetting the tax burden with those distributions as well?
Yeah, so the distributions are fully taxable. As you take that money out of your IRA, required minimum distribution or not, you're being taxed on it as if you earned it, which can, like I said earlier, could have some ancillary effects. For example, Medicare premiums can be impacted because your income and your Medicare premiums, what you're paying, are directly tied. So when you go into RMD phase, you can end up putting yourself in another bracket, paying higher Medicare premiums as a result. So the way to avoid the taxes on the required minimum distribution or take it on earlier is convert earlier, pay the taxes now, and then you convert that money and you'll never pay taxes on it again while it's in the Roth IRA.
Percentage of your savings that should really be allocating and perhaps bucketing towards medical expenses.
Yeah, so I mean, that really depends on your personal situation, right? If you're rather healthy, you can have that bucket a little lower, less filled, if you will. If you are somebody that goes to the doctor often, has medical conditions, then I would err on the side of caution and perhaps have some additional funds available.
Larry, great to see you here in studio. Thanks so much for taking the time.
Thank you.
Absolutely. Coming up, everyone, we're discussing the challenges Black Americans face in the workplace and give actionable steps to overcome them. That's next on Wealth. An online campaign calling for an economic blackout. Friday, February 28th, the People's Union USA, a grassroots group, is urging Americans to spend no money for a full 24 hours. The goal? To remind corporations of consumers' economic power. Here are the details. The no-spend blackout will last for the full 24 hours on the 28th. Participants are told to boycott shopping both online and in person, especially at major retailers like Amazon, Walmart, and Best Buy. The organizers say essential items can still be bought if absolutely necessary, things like food, medicine, and emergency supplies. And if you must spend, only support small businesses. The economic blackout comes at a time when Americans aren't feeling great about the U.S. economy. Consumer confidence in February plunged by the most since August of 2021, according to the Conference Board. Expectations around the job market and future business conditions weakened, and concerns around Trump administration policies dominated survey responses. Amid President Trump's efforts to eliminate federal DEI programs, consumers nationwide are participating in a 24-hour economic blackout that encourages no spending at all. But if you must spend, it's encouraged to buy from local businesses. So we want to dig into the effort further with Sherry Dunn, who is the author of the new book, Qualified: How Competency Checking and Race Collide at Work. Sherry, great to have you on the program here with us. First, let's just get a read in on what's taking place here and what we've been discussing and monitoring coming up to this event of the purchasing and the buyer's blackout, the shopping blackout here today, and ultimately some of the drivers of that, especially as it is an attempt to really showcase the consumer power going up against some of the big corporations who have moved away from DEI initiatives that they set forth and announced just a few years ago.
Yeah, exactly. You know, the thing of it is, the goal is for consumers, specifically consumers of color, other minoritized groups, people who are impacted by these anti-DEI measures to say, hey, we can hear you and we can see, and we are consumers and we are employees and we want to be represented in both spaces. And if we're not, we're going to use our economic power. And, you know, it harkens back to the Montgomery bus boycott. And I often say, you know, if those folks can organize their pennies, we cannot spend online at Amazon, you know, for a day. And the goal is to remind corporations that there is reputational and financial harm that also comes with abandoning diverse consumers and diverse employees.
That's a great point, especially considering the social interconnectedness now technologically that we have versus even when there was organizations back in the days of the Montgomery bus boycotts as well here. Sherry, while we have you, jobs numbers, they will be Wall Street's big focus next week. And while the headline unemployment rate is at 4%, it's much higher for Black Americans at 6.2%. And we showed the cover of your book. Your book is all about some of the challenges that are facing Black Americans in the workplace, including what you call competency checking. Can you define what that is for us and just talk about the economic impact of it?
Yeah, competency checking is the ways in which Black and other people of color, and to some extent women, are required to meet a higher, harder bar in employment and retention. So, you know, it's a questioning of their capacity, their intelligence, their qualifications. They have to prove what they know over and over and over again. Any mistake is remembered, but any qualification is not. There is a false notion that Black people are unqualified and getting all these jobs. First of all, as you say, the unemployment numbers and the employment numbers don't bear that out. But what we also know is that Black folks actually are having more education, more experience, and getting jobs that are not commensurate with that education or experience. So competency checking essentially is the ways in which assumptions about our intelligence, assumptions about our qualifications act as a blockage, preventing us to move forward. It's not based on reality. It's based on historical understandings and belief about the intelligence and ability of Black folks.
And falsehoods as well. And so all of these things considered, what has the economic impact been that we can measure?
Yeah, the economic impact is extreme. Black Americans, because of racism, there's recent data research done showing that it's a $16 trillion drag on the economy, meaning that is money that could be circulating in the economy if there was not the level of discrimination against Black people preventing our full participation. Also, we know in the entrepreneurial space, in the VC space, Black Americans do not get as much investment as white folks in the VC space. That means you have less companies, less opportunities for growth. I mean, this has real economic impact. And of course, in the corporate spaces, right now, I believe there's like 1% of the CEOs, the profit and loss leaders at corporations are Black. And they Korn Ferry did a survey that says they think it's going to be 0 in the next couple of years. That has impact. So this has an impact. When you're artificially depressing a group of your economic market, that has an impact. That stops growth. And of course, people are scared currently. I mean, there's no way you can't watch all of these layoffs and the targeting of so-called unqualified people and not be fearful about your job prospects. And of course, that stops your spending.
And so how can companies change themselves in order to check their own competency checking at the door?
Absolutely. You want to ask yourself, who am I giving a break to and who am I not? When we look at who are we promoting within our companies, who gets the benefit of the doubt here and who doesn't? Who succeeds here and who doesn't? Do you notice trends? Are you seeing a shedding of Black people from the workforce? What we know, and I say this in my book, is that Black women are the canaries in the workplace coal mine, and they are being shed from the workplace at an alarming rate. In fact, that unemployment rate for African Americans you cited, the 6.4, I think, percent, is in large part due to the number of Black women who are being shed. So look at who is leaving, who gets promoted, who gets the benefit of the doubt. What assumptions are you making? And how are your systems set up to check those assumptions? Again, like I say, the data tells us that Black people are showing up with the qualifications, with the skill, with the experience, and yet they are not being promoted and they are having a hard time at retention. So that tells you, as a company, something is going wrong and you need to investigate through auditing your processes and your procedures to figure out what that is.
Sure, some great tips for corporations out there. Thank you so much for taking the time here with us to have this conversation. Appreciate it.
Thanks for having me.
Let's do a final check of the markets as we're taking a look at the major averages on this personal consumption expenditures day. PCE, the Fed's preferred inflation gauge, as we've been continuing to monitor any of the market reaction to it. And we've largely been holding on to these gains for much of the session, as we're seeing fractional gains pretty much across the board at about 0.5%, or just a little bit more than that. And then additionally, checking in on Bitcoin. Over the past 24 hours, dipped below 80,000. It's now hovering within that 80,000 range here, sitting at 84,000 right now. That's it for wealth, everyone. I'm Brad Smith. Thank you for watching. Stay tuned. Market Domination with Julie Hyman and Josh Lipton comes your way, 3 p.m. Eastern Time.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's time for Yahoo Finance's Market Minute. Stocks higher this afternoon following an inline inflation print. Still major averages poised to end the month in the red. Nvidia whipsawing this morning. Shares now just over 1% following a massive post-earnings sell-off. The chipmaker losing over $270 billion in value on Thursday, sending the market cap below $3 trillion. Archer Aviation shares jumping after earnings. The electric aircraft maker eyeing growth in its defense business. Archer also expecting to deploy its initial fleet of its Midnight aircraft in Abu Dhabi later this year. And Fubo TV shares tumbling as the company expects to lose subscribers in the first quarter and miss revenue expectations in the fourth. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan that QR code below where you can track the best